All right, everything looking good. We are live. Let's go ahead and get the stream started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8:04 Eastern Standard Time on 7/3/2022. And like always, before we get started, I would like to remind each and every one of you that this is not financial advice. I am not your financial advisor. These markets are extremely volatile. Please do your own research and, of course, trade responsibly. This stream is for entertainment and education purposes only. All right, somebody just let me know in the chat. Everything's coming through loud and clear. You may have, appreciate that, Jay Hoff. You may have noticed also that now, in order to leave a comment in the chat, you have to be a subscriber for 20 minutes or more. So hopefully that will keep the sex bots or trolls or whatever they are out of here. So we'll see how it works. I'm sure that YouTube wanted them gone, they would be gone. So probably ways around it. But that being said, let's go ahead and jump right in. Obviously, we saw basically a weekend of nothing for crypto. And our last stream on Friday basically was the market wrap up. So at this point in time, we have seen the weekly close, the monthly close, the quarter close, and then also our half has closed as well. So quite a bit of information now, and very soon we're going to start to see the actual numbers come out. And essentially, I mean, regardless of how you want to look at it, whether it's going to be the truth revealed or whether it's just going to be statistics, and then the market has to adjust. It's very obvious at this point in time that, more likely than not, we have entered into a technical recession. But regardless of whether or not it's a technical recession, we're very clearly in a recession. Again, it just depends on what your definition is. People always are going to have different definitions. So textbook definition versus reality. And obviously reality is the most important, but the market is going to take that information accordingly. So if we do confirm that we're in a recession in the United States when we get our second quarter GDP numbers, obviously the first quarter was, negative 1.6. And the most recent update from the Fed, their prediction was basically originally 0. And then they actually said they expect that we have negative growth for the second quarter. So when we get those numbers, we have to look at it as what the market has priced in and then how the market's going to react. So if the numbers don't change and we're not in a recession, say we print 0 or 0.1 growth or whatever, we haven't technically entered a recession. Therefore, the market doesn't think we're in a recession. Therefore, there should be no real change in one direction or the other. If we print negative growth and confirm that we are in fact in a recession in the United States with 2 consecutive quarters of negative GDP or declining GDP, we confirm into a recession, and then the market's going to have to price that in. So that is not being priced in currently. So as soon as we get those numbers, if we confirm into a recession, we should expect the market to react accordingly. And by react accordingly, I mean bad. We are not in this like upside down weird environment where bad news is good news and good news is bad news and all the weird ways people try to like think themselves into circles. That's not the case. If we confirm into a recession, it's going to be bad for the markets, because the fact of the matter is what was making good news bad and bad news good was the Fed was on the side of the markets. So if we got bad news, that would mean that we would get more Federal Reserve intervention. If we got good news, it was bad because that meant that the Fed was not going to intervene or not going to pull back on its easing. So that being said, that is no longer the environment. So if we get bad news now and confirm into a recession, the Fed is not going to just stop hiking rates because we still have inflation. So the big difference is, and what people don't realize, understand, or aren't taking into perspective is that the Fed mandate is 2 things: employment and price stability. And up until very, very recently, the Fed actually just pivoted, and people don't realize it. We pivoted from the most important thing being employment to employment no longer mattering. As a matter of fact, Jerome Powell has specifically said that not only is employment not the priority right now, price stability, obviously, aka getting rid of inflation. That's the priority. Not only is that the priority, but now they don't even care about employment. As a matter of fact, they want less people employed because there's too many job openings. So not only is the Fed trying to specifically control inflation, and that's the only thing they care about, but they are specifically going out of their way to make sure that there are less jobs available or less people employed. They are going out of their way specifically and have even stated in less words than this that they want to see equity markets pull back, crypto speculation pull back, and then the housing market as well. So now we are no longer in an environment where good news is bad news and bad news is good news. Because the truth is, if we confirm into a recession, the Fed is not just immediately going to pivot and say, oh my gosh, we accidentally put the economy in a recession. Oh no, we should stop doing whatever we're doing. This is horrible. No, they are going out of their way to make sure that that happens. So yes, that is a step in the right direction. Yes, in the future, the Fed might take that into account, but that doesn't matter until we rein in inflation. So even if we get bad news now, and that's good to the Fed, so in this upside down weird world, people would think, oh, well, we can get excited because we have a recession, so now the Fed's going to stop doing what they're doing. But they're not, though. They're not, because the only thing that matters to the Fed, the only thing that matters to the Federal Reserve of the United States is reining in inflation. So until we get multiple inflation numbers come in as declining growth or decelerating or declining inflation, until we see that happen, the Fed is not going to pivot. They are not going to pivot unless we see a full-on meltdown of the debt markets or some black swan event like a war or whatever the situation is. But we know that because they have said it over and over again. And Jerome Powell is very, very clear. Very, very clear. And when he was addressed about the Fed essentially leaking out in advance that they were going to do 75 basis points instead of 50, when he was asked about that, they asked him if that eroded away at the Fed's credibility at the press conference. And he said, no, it was important for them to make that move. And so basically they said, so we just, it was in a blackout period. It's very uncommon. That's only happened a couple times in history. So we just did what we do. And, we just leaked it out. Who cares about the blackout period? We just leaked it out to our favorite reporter and told them to put it all over the news. That way the market was prepared in advance. So there's nothing. There's no reason to think all of a sudden the Fed is going to pivot until inflation numbers come down. So that being said, we should watch all of those numbers, PPI, CPI, all the different, metrics. But until we basically see them coming down, we know that the Fed's not going to make a move in the opposite direction. Matter of fact, the market is already saying, there's no way they're going to do another 75 basis point hike. But Powell specifically said in the last meeting, he specifically said 75 basis points is a big hike, and we don't expect to have to do many more of those. And then he basically said, he literally said, but we do expect that we're going to do 50 or 75 again at the next meeting. So there's no reason at this point in time to think that we're doing less than 50. Unless the numbers come out really bad, I don't think we'll do more than 75. And if they are going to do more than 75, they will probably leak it out to us in advance. But the fact of the matter is, I would just expect another 75. Because the Fed's target by end of year is like 3.25, and we're at 1.6, and we're halfway through the year now. So that being said, they have raised rates by 1.5 so far this year. So if they're going to get to 3.0, we need at least another 1.5. If they're going to get to 3.2, we need, slightly more than that. So let's just say we're going to try to get to 3.1, and we were at 0.1 essentially. So let's just say they need a total of, 300 basis points hike or 3% from, beginning of the year to the end of the year. Well, they've done 1.5 so far. They did a 25, a 50, and a 75. So it's not unrealistic to think that we're going to get either another 75, then a 50, then a 25, or a 75, then, a 50, and then a 50, or some other form, something similar to that. We could even possibly get a 50, a 50, a 50. That's a possibility. But at this point in time, we need to be realistic about what's taking place here and then see if that target ends up being what they're still shooting for by end of year. But until something changes on that front, I think there's a pretty clear path laid out by the Fed, and we should, obviously respect that. because there's a reason they're laying it out. It's all about market, anticipation. So that being said, let's take a look at what we have going on here. So TNX basically closing down near the lows. Obviously, the main area to watch is if we take out the recent low at about 2.71. And then obviously we have lots of targets on the daily, weekly, and monthly. We talked about this in great detail, especially on the last stream. But essentially what I'm looking at here is on the monthly, we just want to stay above or around 2.65 or higher. And essentially we are just confirming into a bull run. So at this point in time, I don't care if we just go sideways because we broke through resistance and now we're just hanging out on top of support. So we all know that the longer we spend at resistance, the more likely we are to break through it. The longer we spend at support, the more likely we are to break through it. But we have broken above support for now. So if we just consolidate at this level and the 200 simple flips blue on the monthly, I think it's more likely than not we're confirming into a bull market and going to see further upside potential. And of course, there's typically a gap between the TNX, the 10-year Treasury yield, and the Fed funds rate. So that being said, essentially we would expect this to, by end of year, we would expect this to be above 3% plus that difference. So, and it's not like a factual, it has to be exactly this number difference, but, somewhere around less than 50 basis point difference. So if we're expecting Fed funds rate to be at 3% by end of year, I think it's realistic to think that the 10-year is going to probably be at like 3.5 to 3.7 if assuming the Fed funds rate's at 3.0 to 3.2 by end of year. So we say 50 basis point difference, 40 basis point difference, something around those lines. So that being said, in all reality, it tells us, okay, we have 6 more monthly candles in this year. We're on the monthly chart right now. So we would expect those 6 monthly candles to be somewhere around this area. But obviously by the end of the year, we're expecting it to be actually probably higher than the high so far. So if our previous high right here was 3.5 and we're expecting at least, probably 3.5 to 3.75 on the 10-year TNX by end of year, that tells me we're just going to be hanging out above support, possibly even going higher. We don't know. It could be worse than that if the Fed has to hike rates more, but we don't think it's going to be less than that, obviously. It is possible, but really, where does that put us at? Well, if let's say the Fed is slightly wrong and maybe we close out the year at, let's say 2.6 or something like that, we're still basically above the 200 exponential or simple. So the only way that this chart doesn't confirm into a bull run, which it's basically already done, the only way it doesn't confirm into a bull run is if the Fed is completely wrong, something happens, and the Fed pulls back rate increases, or at least does almost no further rate increases. So we basically can confirm that if we get our next rate hike and it's 75 basis points, and then all of a sudden, we can't go any lower than that, essentially, because the spread between 10-year and the Fed funds rate is typically right around that level. So, we're basically just confirming into a bull run. So worst case scenario, we just hang out here and we confirm the bull run as the 200 simple flips bullish, 200 exponential already bullish, and everything else is extremely bullish. Or the Fed is slightly wrong, we hang out right here. Or, I'm sorry, the Fed is wrong and we have to go higher by end of year. And then this is going to be much, much higher. We might be at 4, we might be at 5. We don't know, because we know this thing front runs the Fed funds rate. So this is already taking into account, what the Fed's expecting to do by end of the year. So again, if there's a worst case scenario and the Fed does less, or best case for the markets or economy, still a bull run. And if it's the worst case scenario, the Fed is wrong and has to go much higher, then we're confirming into a bull run. So as far as I'm concerned, unless something massively changes, we're confirming into a bull run, and there's nothing that's going to change that until we get some kind of black swan event, essentially. So that being said, obviously very, very important, because that tells us that TLT is not going to be going into a bull run anytime soon, because obviously they trade inverse. This is the 20-year Treasury bond, not the yield, but all we're doing is just backtesting resistance as expected. So we broke through support, we're backtesting it as resistance. Could very likely see us up closer to like 120 rather, sometime in the next couple days, weeks, month. If we consolidate here and hold that support, then we could potentially get back up to the heart line of the channel or the ascending resistance, closer to like 130. But again, when we start looking at this and say, well, what are the next 6 months going to look like? It's pretty obvious that this is probably not a safe bet right now. Now in the future that may change, but it doesn't look good to me. So here we have the VIX on the daily. So again, we're just oscillating inside of this ascending or symmetrical triangle. Obviously coming out of a breakthrough of the channel, we broke above it, and now we're operating inside this channel, and now inside of that channel we have a resistance. The bottom of the channel and the 200 moving averages are basically support. So we're coming down here to test support. We know that the last however many times we have hit the bottom of this range, we bounce back up and then we retested the top of the range. So most likely we're going to continue to operate inside of this range. So that being said, what does that tell me about the stock market? Well, we know when the VIX is going down, the markets are going up, and when the VIX is going up, the markets are going down. So it tells me that we're probably very close to the markets reversing again and going back to the downside as the VIX pushes back up to the upside. And again, we would expect this to act as support, this to act as resistance, and just continue chopping sideways. We will eventually break out of this triangle. When we do, we'll break one time, we'll confirm that break, and then we'll see continuation. And then we can start looking for either, if it breaks to the downside, a massive equity bull run, or more likely it breaks to the upside and equities sell off violently. And is that going to be tied into some of these important numbers like inflation numbers and rate hikes and important data like that? 100%, of course it is. So that is why it's so important to pay attention to these specific things, as they will dictate the overall markets. So some things can still go up when the VIX is going up, but the majority of the markets are going to trade inverse to the VIX, as typically the volatility is when we're going down. But I do expect elevated volatility till year end, probably longer than that. So next we have U.S. oil, WTI crude. So we obviously have been we've been through the setup a million times. We broke down from the ascending support. We're back testing it, putting in consistently lower highs, expecting this to come back down and retest the bottom of the yellow channel. That's also corresponding with the 200 exponential or simple. We have a Fibonacci slightly above that, about 97.50. And then obviously 100 is a nice round number. So somewhere around this level is where we're basically looking for price action to end up. And probably somewhere around this time as we kind of touch down on the moving averages. Now we are seeing some bullish momentum pick up here. It looks like it wants to get across and a hard buying signal. Oftentimes we'll get something like this, where we get a hard buy signal and then immediately rolls back over. We get the hard sell again, and then we actually complete the move, which is what I'm expecting, something like that. So we're about to cross back to the upside, get a little follow through, it fails, we go back down, we put in a new low, and then we cross back up the next time, and that's when the actual move back up starts. So that's what I'm expecting. We come back down here, and then we get a move back up, and then what we'll be looking for is, we have a high, we have a lower high, and then essentially a third lower high is what I would be expecting, assuming, oil is going to cool off for a little while. Now, if that's not the case and we start getting bullish, anything could change, but essentially what we're expecting is a buy somewhere around 95 to 100 down here, and then a potential sell target back up in here somewhere around 117 to 120. So a nice little 15-20% scalp. Definitely looking for that possibility on oil. Oh, and you know what? Just wanted to look really quick at this monthly as well on oil and just talk about what we're seeing now take place. So we talked about essentially this situation taking place here. Basically, what we're seeing happen is we had a pretty bullish move to the upside. We saw a pretty clear rejection. We did see some follow through. And now, we put in essentially a not quite bearish engulfing, which is definitely good. We finished a little bit off of the low of the previous candle, but we're essentially pretty exhausted right here. We have the hard sell signal. We have left the bullish control zone. That's typically topping signal. And then obviously a bunch of green histograms still. We still closed last month green, and we're seeing green on this month as well. But when we just look back here, every time we've gotten the signature, the hard sell, it has resulted in a pretty heavy sell off. And we haven't seen that take place yet. So, how much of a sell off it is it going to be? Probably like 3 to 9 months, and, anywhere between 30% to, 60%. So that's what I'm expecting sometime in the near future. Now, we could easily come back up here, put a new high, squeeze everybody out that thinks we're going to go lower, and then we get, more of a violent sell-off. But I am expecting oil to come down or at least level out here for a couple of months, as it looks pretty tired. Here on the weekly, we see bearish divergence taking place. between our two peaks on both the Jewel Thief and of course on the TDMACD as well. And now we have lost our 8 as support, and we're bouncing between the 8 and 21. So again, eventually we would expect to lose the 21 and then retest those lows. And again, that's going to be right around the bottom of the channel, the shorter term moving averages. And then we can start looking for, potential move back up, and then that lower high and pull back, maybe back to somewhere around like low 80s or something would be our target, a little more long term. So, but we're seeing quite a bit of confluence, and it really looks like the energy trade is a little tired for now. Now, that doesn't have to be the case. We can pick right back up and go much, much higher, depending on what's going on with Europe, sanctions, all that stuff. So Dow Jones on the daily. So obviously we closed a pretty bullish candle there on the daily off of support, but we didn't get much follow through. When we look at the weekly, again, we have basically just bounced perfectly off the 200 exponential. And when we see on some of our weaker indices, we essentially see that bounce off the 200 exponential, a rejection back off of the 8, and then a move back down to the 200 simple. And that's what I would expect. A move back down to around 29, roughly 5 to retest the 200 simple. And then we could potentially get, a move back up. But it doesn't seem likely to me that we would just bounce the 200 exponential and then just see follow through, and that's it. So again, we'll see what happens when we look at this monthly here. We have all but confirmed the cross to the downside, but we specifically spoke about why now is not the time to get bearish on equities, especially on Dow and the S&P, because typically what happens here, and we displayed it every single time, before the cross takes place, we break down, the candle opens right here, we push up all the way back above the cross and try to stop it, and then we get rejected all the way down, and then we see a big nasty follow through. And that was the Rona dump. And if we go back here and look at 2008, again, we break down below it, we come all the way back up, fail to cross it to the upside, and then we see the follow through. And we see the same thing for 2000 as well. So what we want to look at right here is the potential that sometime this month, we're probably going to see a move back up to about 32.5, maybe even a wick higher. And then we see, okay, do we close back above here and save the trend and go higher? Very unlikely if we confirm into a recession and with everything going on. Or do we come back up here and then get rejected? Smart money exits their positions, and then we go much lower, which is obviously my base case scenario. So the same thing on the SPY. If we just flip out here to the monthly, same exact thing, expecting basically a push back up sometime this month to around 406, 407, 408, somewhere around there roughly. Could easily see a wick go slightly higher, but we look at that as a liquidity, event, essentially an exit position before we go lower, as just like we explained on the Dow Jones. Hard sell, bunch of red histograms below the slope line, slope is flip red, 8 and 21 getting ready to cross to the downside. So very clearly, very similar, the Dow Jones and the S&P are right now. Numbers are different, but the charts are very similar. So NASDAQ next. Obviously, we were looking at that bullish divergence. We saw it play out. Very pathetic move. Could not get back above the 8 or the 21 for any amount of time. The weekly, just like we were talking about, when it bounced off the 200 exponential, it came back up and hit the 8 and then gets rejected, comes down to the 200 exponential, then comes down and hits the 200 simple. And that is what I want to see from the Dow Jones and the S&P, as not nearly as many bots, algorithms, whales, market makers in the traditional markets or stock market are using exponential moving averages. Most of them are using 200 simple moving averages. Therefore, it seems much more likely that we would see confluence off of that level. Obviously, we see some initial bounce right here, and then it plays out. So we'll see, and we'll look for that, obviously, on our other indices as well. And then we go to our monthly. We have confirmed the cross down. You'll see here we're very close to confirm the cross. We try to push up. Doesn't work. We try to push down. Doesn't work. We close around the same. And then we see the follow through as, basically reality sets in. Hard sell, stochastics accelerating to the downside. All red histograms below the slope line. Slope is flipped red. 8 and 21 have flipped red. So obviously, I don't have to tell you that the NASDAQ looks absolutely terrible. So it looks likely that once we do get our next flush down, we're probably going to come down to around that 91.69 level or somewhere around there. Obviously, we have some other key levels, the fibs and everything. But that right around like 98 is our wick, 96 is our close on the monthly. So that's what it looks like we are expecting there. And the Russell, once again, very similar. A little bullish divergence, barely plays out. We get almost no follow through on that move. Here, the Russell has not only had that bounce off the 200 exponential, drop right through, and then off the 200 simple, gets rejected, and then drops right through again. So the Russell technically on the weekly is even weaker. Not surprising, since we didn't even put in a new high in 2020. We had a 2018 high. So obviously the Russell is trash. I mean, it's composed of trash. It's not the Russell's fault that it's full of junk zombie companies. So on the monthly, again, all red histograms, hard sell signal, entered into the bearish control zone, red slope line, hard, the cross on the 821. We're already revisiting 2018 levels. The Russell obviously just looks absolutely atrocious, by far the worst of the major indices. We are holding that support for now. For now, I use that term very loosely, but we do have quite a bit of support, basically going back to like 2016, 2017 through here. So, we're at the 382 now. Next target would be the 0.5 around 1542. That's also the measured move of the flagpole leading into our ascending consolidation channel, typically followed by another flagpole, most of which has already played out. But the 0.5 would be 1545, and that is our next target to the downside. All right. So XLI industrial, again, very weak. Didn't put in a new low right here, but definitely showing what's going on in the economy a little more clearly. And again, very close to the 821 cross. Don't want to rule out that push back up to retest like the 93, 94 level. But we're looking at those as exit pumps. We're looking at them as liquidity events. A push back up to resistance in order for people to essentially exit their positions before we go lower, and all momentum pointing to the downside. Next we have XLP, consumer discretionary, coming back up to retest the 200 exponential and simple, attempting to avert the bearish cross, or rather the bearish flip of the moving averages, confirming into a bear market like everything else has. So obviously XLP, consumer staples holding up. We know that the safety sectors are, consumer staples, utilities, healthcare, and typically, real estate market. So, makes sense that people are running to them for safety. And so far, they're holding up much better, but very clearly just a couple months behind, confirming into a bear market like everything else did already. So here on the monthly, just oscillating between the 8 and 21. Definitely seeing some weakness in the chart, and expect some follow through, but definitely going to take a little time. So XLF, financial sector, didn't quite put in new lows here on the daily, which is good. But when we zoom out and look at the monthly, very close to confirming that bear market move. So again, potential move back up to retest 3473. Keep in mind, please, as I say these potential moves back up, I'm in no way bullish. Obviously, we're now confirming into a bear market, or have confirmed into a bear market. So we're no longer looking to buy the dips. We're looking to sell the rips. Now, it doesn't mean that you can't scalp inside or counter trend. It just means that the probability of success is much, much lower. So if we give a probability to success of trading with the trend at 66% and a probability of success trading against the trend at 33 roughly percent, that tells us that if the trend is now confirming down, we want to sell the rips. If we're in a bull market on something, we want to buy the dips for the highest rate of success. And then assuming we're trading with the trend, we can take 2-to-1 risk reward trades and still be profitable long run because of the 2-to-1 risk reward plus the probability of success. If we're going to trade against the trend, we need to get at least 3-to-1 risk reward ratio in order to make up for the probability of success being 1 in 3 essentially. So that being said, XLF, definitely hard sell, leaving the bullish control zone, all red histograms, flipping the slope line red, and very close to the 821 cross to the downside. Very much pointing towards a retest of the monthly 200 exponential and 200 simple in the low $20 range. XLRE, so real estate holding up fairly well, especially in that last little move up. We obviously saw some bullish divergence, not getting very much follow through. When we look at the weekly, we did get the 200 simple test there. We obviously tagged the pre-Rona levels. And then obviously on the monthly, hard sell, left the bullish control zone, all red. Slope line is still blue for now, but we are below it. And, again, it looks likely that we come back up, retest the 821 before we have a negative cross. Can we avert that cross? Maybe. Seems unlikely, but right around 44 roughly would be the retest for that level. And again, this chart still looks very, very bearish. So, it looks like we may get a push up here, but obviously that is a selling opportunity, in my opinion, an exit pump, basically. XLB, healthcare. So again, we have confirmed the bear market here. We retested it and it failed. We came down, put in a lower low. We're back up here retesting it again. So the first time we got rejected basically at the 200 simple. This time we'll see if we get rejected lower at the 200 exponential. The most important thing we're paying attention to is the high, the low, the lower high, the lower low, and expecting once again a lower high here as well. So the area we'll be watching will be basically, this is a key area to watch right here. If we get above that right there, then we can look at it two different ways. And it's important that we look at it both of the two different ways. This could be the high. This could be the low. That could be a lower high. That could be a lower low. If this comes up here and takes out this high, though, we have to say, okay, wait a minute. Maybe we're not wrong. We're just looking at this slightly wrong. So please ignore that it's an Elliott wave, but I just want to demonstrate this is essentially what we're expecting. And then a new low down here. But it's possible that that's not what happens. It's actually possible that what we see take place is something more like this, where this is our high, this is our low, then we get our lower high back here and complete the right shoulder, and then we can come down and put in a new low, and then, obviously we just keep going from there. But this could be just an internal move of one leg down before we get a leg back up, or it could be a leg down, a leg up, a leg down, a leg up, a leg down. So we don't know for sure which one's going to happen, but I promise you this, that the best way to trick the market is by doing things like this, where you think this is all separate moves down, and it's actually just one move down, and then this comes up here, takes out this, comes all the way back up here. Everybody gets very bullish and says, oh, look, it's a higher high. We took out that previous high. We're going back to the upside. And then what ends up happening, we get the double-headed, head and shoulders breakdown. Now, obviously, this is very ugly now that we broke down through here and lost key support. So, it's more for just like an example of what could happen than like a very clear technical chart pattern that, we expect everybody else is looking at. So that being said, if we switch out here to the monthly, this looks like basically a topping pattern. We're slowly closing lower and lower monthlies. So here was our lowest monthly close since we basically peaked out. So again, as long as we're below the 8 on the monthly, above the 21, we're basically just range bound here. But eventually, if we do lose this level, that's when it starts looking a little nasty. So hard sell signal left the bullish control zone, all red histograms. The slope line's still blue for now. If we go to the weekly, though, we are still well off of the 200 exponential or simple. So if healthcare wants to come down here and retest the same way the rest of the market is, we're talking about like 113, possibly like 110. And we have on the weekly, multiple drives in a row of bearish divergence. 1, 2, 3 drives, 1, 2, 3 drives, and then we sold off to a new low. So is it done playing out? It could be. Or maybe we're just coming back up to retest before we go slightly lower. But definitely has some room to the downside if it decides it wants to for healthcare. And again, a lot of this is probably rebalancing at the end of the month. This little bullish push up was probably people just pushing a little more into healthcare as, they're looking for some safety in the markets. And typically you'll get less volatility, and they typically pay like a decent dividend. So XLB materials breaking to a new low. Even on this last couple like daily moves down here, a new low looks very, very weak. On the monthly chart, we haven't quite confirmed to the downside yet, but again, this is a very bearish candle right here. And I think it's realistic to say that material is probably telling us a little more accurately what we should expect in the near future. So, do we push back up here, try to stop it around 80? Probably do. But eventually, I think we're down here back at like the 62, 63 level, the pre-Rona level. And then obviously, again here, we see that was the 2018 high. This was the 2020 high. So this was already weak going into it. It was only through all of the liquidity pumped into the system from our, sweet 1%ers or 0.1%ers that made the chart even look like this. Otherwise, it probably would have just put in another lower high and continued to go lower. So definitely some room to the downside here if this wants to let go. And we see very clearly, obviously, this big old red candle and, you know, the acceleration of our indicator oscillators, that we are picking up steam to the downside. We're gaining momentum to the downside. So not the best time to be buying the dip, in my opinion. But what do I know? So XLY, consumer discretionary. So hanging out at the lows here. Again, we see some bullish divergence on the daily with weak follow through. If we look at the weekly, we're down below the 200 simple. So very weak, already losing the slope on the 200 exponential in the bearish control zone. And then we zoom out to the monthly, we have gotten across to the downside. You know, we essentially broke down. We attempted to stop the cross. It failed. And then we just sold off right afterwards. So we'll have to see what happens. If the rest of the market decides to move back up, maybe we come back up one more time to like 156. But eventually we have to start paying attention to, you know, the 2020 top at around 125. And then potentially the lower level of the 2020 drop and the 200 exponential / 200 simple down here about 95. Again, hard sell, leaving the bullish control zone, all red histograms, red slope line. I mean, it's not like we didn't see all of this coming. Obviously, the indicators and the strategy work phenomenally well. So XLU, same thing. Safety sector, everybody's coming in to buy up the dip off of key support. We were obviously paying attention to this and specifically spoke about how we didn't want to get bearish right here at the bottom, because this essentially looks to me like an intentional break of an ascending support. And every time we have done it previously, we then shot straight back up to the upside. So you're like, well, maybe you just have your chart drawn wrong and, you know, it should be lower and then we should just find support at that level. Well, maybe. But also, you know, if we just go back and look at this, you know, going back to like 2008, it's probably drawn perfect. So, but, you know, maybe it could be slightly different. Maybe you could angle it like a little more to the downside and get like a little bit more, maybe something like that. It's definitely possible. The most important thing is, you know, not if it's perfect, but if it's working, if it's functioning, if it's giving us what we need to see. So regardless how we want to look at it, the most important thing is we have this massive channel. It's been going on for a long time. Every time we've come back down to the channel, we've shot back up to the top. And that's, again, what just happened. So, you know, safety sector, everybody swoops in, buys the dip, shoot back to the upside. I mean, makes perfect sense to me. If we go out to the weekly, again, one of the best, one of the strongest charts right now. Still technically putting in lower highs and lower lows. So not great, but better than everything else. Trying to stop that weekly cross that just took place. And then on the monthly, still above the 8. Again, holding up much better than basically anything else is. So, but that being said, we do have some pretty clear monthly bearish divergence here. If we close one more month with a red histogram here, that basically tells me that this bearish divergence is probably going to play out soon, and we'll start retesting some of these lows. But if this has bearish divergence and starts playing out, the rest of the market is probably going to look atrocious. XLC on the daily, hanging out at the lows. We see that bullish divergence again. Pathetic move back to the upside. So maybe if we get a second or third drive, more likely to get some follow through. But we essentially see communication has completely round tripped. We are now back at our 2020 levels right here. And realistically, I mean, if this area doesn't hold, I mean, even if it does temporarily, I'm fully expecting us back down here at, you know, this 38 level. We have multiple touches down here for support. There's a couple steps around the way. We're basically bouncing the 618 perfectly. But next target will be the 786. And then, you know, it seems more likely than not that we're just going to be round tripping all of this bullish price action. And then when we look at the monthly, we broke down from that key support. We found support at the 618. We're in the bearish control zone. We have all red histograms below the 0 line. The 8 and 21 monthly have crossed to the downside. So, you know, one of the most bearish charts of all of the key sectors. XLK technology, again, revisiting the lows right here. Some bullish divergence, not really getting any kind of pop off of it. The daily is very much in a bear market. Our weekly, we're just off of the 200 exponential or simple, so it seems likely we're headed down to 118 or 112 in the near future. And if we zoom out here to the monthly, very close to getting the 821 cross. Seems likely that we would get a pushback up here sometime this month to retest around like 141, 142, try to avert the bear cross. But again, you know, if this cross does take place, we have not seen a bear cross on tech since 2008 and then 2000 before that. So if we do get that bear cross, I expect a lot more pain in the market. So if we come back up here and retest 141, we're looking at, you know, 51 to 60% drawdown from where we're at currently, which is already well off the highs. And obviously all of the indicator oscillators are bearish, with the exception of the moving averages, but they're starting to give us that bearish posture. XLE coming down here, retesting the 200 exponential or simple. We talked about this as a potential buying opportunity. Again, not to get greedy, but I would prefer to see it come down to the 200 simple, as that is a much more reliable technical level. We have quite a few important fibs along the way. We bounced the 382. The 0.5 is slightly lower at about 65. So maybe we bounce the 382 and the 200 exponential. We get a pushback up here to a lower high, and then we come back down. Maybe we come down just slightly more, and we get a retest of the 0.5 and the 200 simple, slightly lower at about 64.50. But realistically, we probably end up heading back up to retest or backtest the 236, which is about 78.83, and then we get further downside. But we are starting to see a posture setting up here for a potential short-term move back to the upside, which again we would expect to result in a lower high. But again, very, very bullish on energy long-term. The real question is, though, we're now confirming into a bull market. At some point in time, we're going to revert to the mean, get that retest, obviously leaving the bullish control zone on the weekly, hard sell signal, multiple red histograms, and you know, looking pretty toppy as the 821 are getting ready to cross to the downside. So seems likely that we will be getting a buy in on energy in the high 50s. And then we zoom out to the monthly, we see those same levels lining up. The 65 is a 200 simple, $58 roughly is a 200 exponential, and we are getting the hard sell signal and multiple red histograms. We know the last couple times we got that same signature was the peak at 2014, the absolute peak, followed by a ridiculous downside move, which obviously we wouldn't expect it to go to zero again, but 75% move to the downside. And then prior to that, we saw this was our peak right here, and we saw a 6 to 8 month correction, which was a 32% move to the downside. And then finally, obviously, we have our 2008 high, which again led to a 58% move to the downside, and probably 8 months down. So I'm expecting something like that. And then I think there's still a high probability that we come down here, retest. People have realized, wait a minute, this energy thing, we're probably still going to need it for a while. And then this probably puts in new all-time highs very soon as we break above 100. Very soon in the next 6 months or so, 12 months or so, but followed afterwards by probably multiple years of a bull run. As the reason we're seeing lack of capital going into the space has been this whole like green agenda and everything, and the fact that the oil, gas, coal industry has been struggling and hasn't put in new all-time highs in quite a while, and hasn't been making money hand over fist. So now all of a sudden they're making a little money. They're trying to return it to the shareholders, and instead of putting that capital to work, because they're afraid that regulation is just going to come back in or uncertain about what the future is going to hold. So all they really have to do to get these companies, oil, gas, etc. companies to invest in their businesses is just guarantee them, we're not going to regulate you anymore or try to cause any further damage to the industry. Just basically just convince them, hey, we're not your enemy. Like, we want to be on team with you. And they can do that in quite a few ways. They could basically just lock in the equivalents of like future contracts with these industries and say, look, we know you don't want to spend money because you're afraid what the future is going to look like, and you guys got burned badly, in 2014. So what we'll do is we'll guarantee you this price plus, adjusted for inflation for the next 10, 20, 30 years. And then that way those companies know for sure what they're going to get, adjusted for inflation, obviously, and then they can, plan, invest accordingly. That's all you have to do. It's simple. Just solved it. I solved the energy problem for the whole world. Congratulations. Everything could go back to normal now. That's it. End of the stream. Bye. No, seriously though. I mean, it's not that hard. It's really not that hard. I mean, I thought of that all on my own. It's not real hard to figure out what you have to do to make, companies that want to make money sell stuff at record high prices. It's not that hard. But, apparently government does not function. I mean, obviously government doesn't function. What do you mean apparently? XTN transportation at the lows, looking very weak. Daily's trying to do something here. Not seeing that same level of divergence. Weekly has broken below 200 simple and closed below the 200. Broken below 200 exponential and closed below 200 simple. Not good. closing weekly at the lows. Bearish control zone, all red histograms. This is a pretty key support level. We have quite a bit of support all the way down to like the $60 range. And then, still quite a bit of support in like the $56 range. Obviously a ton of various fibs along the way. So it seems like the next target to downside is 60. This area should hold, at least short term, I would expect. But it doesn't look like it wants to, honestly. And if we zoom out to the monthly, we're just back testing the 2018 highs now. We have slightly lower to get to the lower high 2020s. So again, we see this looks more like the Russell. It was already weak going into the pandemic, and only everything that took place skyrocketed price of transportation. And now here we are round tripping it completely. So the real question is, are we going to round trip to the lows now, or are we going to consolidate around this area and go higher? When we look at this monthly, there's still plenty of room to run to the downside. It looks very bearish, and we've just confirmed the 821 cross the downside. So, in my opinion, it's only just begun. The pain has only just started. It's only just started. We've talked about this analogy multiple times. We're at the edge of the cliff. We're getting ready to base jump. We're about to jump off of the cliff. And then people are already screaming for the Federal Reserve to pull the parachute. And it's like, hey, we haven't even jumped off yet. We're not even falling. Gravity is not even taking effect yet. And you want to pull the parachute out right now? Not going to happen. Not going to happen. The Fed is more like, they're going to wait until they see the whites of the eyes of inflation. The Fed is like that, insane adrenaline junkie with a death wish that's going to jump off of the cliff, and then at the last minute, right before they hit the ground, at maximum velocity and go splat, they're going to pull their cord then, because we know they're always wrong and they're always late to the party. So we don't even know. They might not even pull the cord in time. They might pull it the last minute. Parachute doesn't even deploy, and we just smack face first into the ground. We'll see. But I mean, are they going to pull the parachute now, or then pull the ripcord now? I don't think so, bro. And I mean, I would love to be wrong. It's so much easier when everything's just going up, melting up, and just you can throw money anywhere you want. It's so much easier. I would much rather, easy money always. XSD semiconductor space. So we are breaking down from key support. We talked about this potential move back up here, to come back and revisit to 200 exponential or simple, as we have just confirmed into a bear market. We would expect a retest. Maybe this was a retest and it was just super weak. I like to see a very clear technical retest where we at least touch the 200 exponential, mostly the 200 exponential and 200 simple, and then a rejection after the 200 exponential and simple have lost the slope. So this was before the slope flipped on both of them. Now we need one after. So is that going to be from this level, and then we get the 236, retest of the heart line, retest of the 200 exponential, retest of the 236, and then we form the head and shoulders, and then we break down? Maybe. Or maybe we're just not going to get that now, and we'll just break lower to the 0.5, see you at 131, and then maybe from there we consolidate around and push up. Maybe we go even lower. We get down to 113. But eventually we expect that reversion to the mean play to take place. But I'm telling you right now, the semiconductor space looks very, very weak. And not like we didn't see it coming, obviously. This is our semiconductor bull run from the lows of 2009. And, if this doesn't look toppy, I don't know what does. The monthly is literally about to cross the downside for the first time. And we know, obviously, the last time that took place was 2011, 2007. And keep in mind, 2008 was the global financial crisis. So this was melting down in advance. So this is giving us a leading indicator. It's telling us what's happening in advance. So this is putting in its bottom in November of 2008 and then moving back to the upside. So this is a leading indicator for what's to come in many ways. So this crossing to the downside now, we could easily see come down to 106, revisit some of these nasty lows. But if we decide to correct this entire structure to the upside going back to 2009, I mean, it's literally only just begun. Our initial target, just to confirm the macro 236 fib retrace from the bottom to the top, is 116. And once we hit that, we would expect a bullish bounce back to the upside. But then we expect a minimum 382 retrace, which is $73. So if we're at 146 now, I fully expect another 50% downside from where we are now, which is substantially down from the highs at like 250. We see the, bearish divergence signal right here. Sell by sell, left the bullish control zone, accelerating to the downside. All red histograms, lost the blue slope line. It has flipped red. Does not look good. and we're very, very close to confirming the 821 monthly cross. And then the same way we look for semiconductors as one of our, four horsemen of the apocalypse, which have all shown their faces very clearly at this point in time. The same way it led into, the recession or, the issues going on here. We expect it to lead us out of, the bear market. So we're looking for the same thing on the way back up, a leading indicator. And there's not a lot of those, out there. So it's important to focus on the ones that we have. So obviously the 210 inversion was one of our four horsemen as well. Very clearly had an inversion. We had another brief inversion here as well. And we're starting to show topping signs on this as we have bearish divergence taking place, hard sell signal on the weekly. We're leaving the bullish control zone. So again, we know what this needs to look like by the end of the year. Essentially just to keep up with what's going on at the Fed. And then here on the monthly, we're just now confirming into a bull run. We haven't actually flipped the 200 simple bullish yet. 200 exponential was already bullish. We failed last time after flipping at blue. All the other times previously, well, we only have a couple because this doesn't go back far enough on the monthly. But we know every other time we've gotten rejected at those levels and then went to a new low. Here we actually got above those levels in 2018, 2017, and then we went to a new low. So if we flip the 200 simple to the upside while the 200 exponential is bullish still, flip to the upside, we're going to be doing something we have never done on this chart, going back to the late 80s. So again, very, very clearly would be an indication that now we're actually going to consolidate and go much higher, and that we would expect to see, we have already threatened or taken out the 2018 highs. The next key area that we would be watching is like the 2007 highs, which is around 5%. So it sounds crazy now because everybody's like, there's no way. No one, the debt and the insolvency and federal bankrupt and all the big clickbait, trigger words, all those things come out and, blah, 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 blah. I don't know if anybody noticed, but the government's been printing money. So if I'm the banker and we're playing Monopoly, okay, and let's say I'm the government, and then you say, hey, I need some more money, and I go, okay, and then I just give you money, or I pull out the money and start Xerox copying it and just handing it out, and you're like, wait a minute, you're paying your debts off with printed money. And I'm like, yeah, because that's what I do, because I'm the government and the Federal Reserve. Duh. I don't understand why it's so confusing to people. It doesn't make any sense to me. What people don't understand about the way the system works is what the government has literally been doing is they have literally been saying, hey, we don't have enough money from taxes to pay for the spending that we want to spend on because we don't know how to rein in our spending and we run massive deficits. And so they're like, so we'll just sell bonds to raise money. So we'll basically give people interest to borrow their money. And then we're like, oh no, there's not enough people who want to buy this debt. If only there was some entity out there that could literally just print up money and then buy our debt. And then the Federal Reserve goes, hey, that's what we do. So then the Federal Reserve prints the money and then buys the bonds from the government. So now the process has started. And then what happens? The government says, oh no, we run massive deficits and we have to pay back all these people that borrowed money from us, but we don't have any money because we run massive deficits. So what are we going to do? Default on the loans? And they're like, oh no, wait, we'll just sell some more bonds. Oh no, nobody wants to buy our bonds. Oh, there's the Federal Reserve. Hey, can you buy these bonds from us and give us the money and then we'll just pay you back sometime? And the Federal Reserve's like, sure, we're just printing money anyway. And they pull out the Xerox copy machine, which they don't even have to do anymore. They just literally print them digits on a screen and then the process starts all over again. So I don't understand how people can understand that whole thing and then still sit here and say the government won't be able to pay its debts. Now, there are lots of countries out there, including, the European Union or the euro dollars, basically, the euro. All these countries are working together and they have a single central bank for their currency. So some of them are going to get screwed because they're going to say, oh, we need more money. And they're not going to get as much money as they need. And there's nobody to come in and buy their bonds. So they can run into trouble. Now, every country that prints its own money, they don't have to worry about that if they have their own central bank. So as long as you are a country that has your own currency and can print as much as you want, the real danger is not that you can't pay your debts, you're insolvent, or you basically default on these bonds. That's not the real problem, the real danger. The real danger is that you inflate away the value of your currency and then nobody wants it anymore. But what people don't understand is, as long as there's hundreds of trillions of dollar denominated debt around the world, somebody is going to need those dollars to pay down that debt so they can be free from the dollar, from the United States. So if in the future nobody wants anything to do with the United States and the dollar system, before that happens, they have to pay off their debt. So if they can't pay off their debt, they still owe it. And it's not just owed to the United States, so they can't just be like, fuck you, we're not paying you, United States, because they probably owe it to an entity in their own country. It's just denominated in dollars. So the demand for the dollar will be the last thing to go, because even if the demand for the dollar goes down, there's still demand to pay off the existing dollar-denominated debt. And that is where the idea of a dollar short squeeze goes in. As the dollar gets stronger, more people need it to settle the debt, to get free from the dollar. So the process of getting rid of the dollar and losing it as a world reserve currency and the world being free of it requires first a massive demand for dollars. And that is where people are completely wrong and why they don't understand how the system works and why they've been on the wrong side of this trade for literally years now, while we have been, stroking. So that being said, we'll take a look at the DXY next. What's going on, J-Huff? Good to see you. Honkiness, hello, hello. Good to see you guys. Make sure to smash that like button and leave me a message in chat. We'd greatly appreciate it as it helps out with the algo and whatnot. So that being said, DXY is next. Obviously, consolidating at the highs right here. We're seeing the dollar stay strong as the yields go down. We do have very clear bearish divergence. We are below the slope line on the daily. We're retesting it as resistance. If we do not break through this, we probably go lower. If price action goes higher and this doesn't go much higher, we could easily have, very clear 2 or 3 drives of bearish divergence and then get a big sell-off in the dollar. We definitely could, But that being said, we know obviously long-term the dollar is still very, very bullish. We're back inside the bullish control zone on the weekly. We're showing quite a few red histograms, but we're still kind of alternating. We have a fresh weekly new high on the dollar. So for everybody who's saying, this is the top, we're topping out. Well, okay, say it again next week. We'll see how that goes. Because we're literally putting in new highs week after week after week. And, we're still very, very bullish. 200 exponential getting ready to cross above the 200 simple. That is literally the last step that happens to confirm into a massive bull run. Is the 200 exponential crossing on top of the 200 simple. And that's our weekly. And then if we look at it on the monthly, very, very bullish. 200 exponential above the 200 simple. Both have positive slopes. 8 and 21 to the upside. New high monthly close. Hello. We literally just closed a new monthly high. So anybody that's been calling for a dollar top since 2008 has literally been wrong. Because the only thing we've done is just over and over put in higher lows and higher highs. So anybody that is bearish on the DXY since 2008 has been wrong. You could be bearish for here for a little bit. You could be bearish here for a little bit. You could be bearish here for a little bit. You could be bearish here for a little bit. But the fact of the matter is, we're in a very strong bull trend. The first one that we have seen on this entire chart, basically, going back to 1981 and what was going on in 1981, a pretty similar situation. We had a bunch of inflation. We had a bunch of issues going on, around the world with like wars and all kinds of like weird stuff going on. Oh, it sounds kind of like what's going on right now. And people are like, oh, it's the end of the world. Oh, inflation's never going to be gone. Oh, eventually what happens? Well, the world didn't end and inflation went away. So seems likely that's probably what's going to happen eventually here too. Now, that being said, we know that the dollar went absolutely parabolic from when it crossed above roughly the 200 exponential and simple, right around 81. The dollar went parabolic. The DXY went parabolic for the next 4 years after that. So if we get a 4-year parabolic uptrend, we probably revisit the previous highs at about 120. And if we revisit the previous highs at 120, who knows after that? Maybe we get way up here. And I don't know how nasty this dollar short squeeze is going to be, but I know if you don't live in the United States or you don't have your income denominated in dollars and you have to pay dollar denominated debt, or you want to buy things in dollars, you're going to be in some serious pain. Serious pain. This is like the equivalence of AMC short squeeze. We know AMC is trash. It's a fact. We know it for sure. It's garbage. It's trash. But it does not mean that it didn't go absolute parabolic because of short squeeze. We know that the dollar is absolute trash. We know that they're quote unquote printing money like crazy and their spending is out. We know it. We know it's trash. But that does not mean that that trash can't go into a massive short squeeze. And I think that's where people get really confused. They think that if you say you're bullish on the dollar DXY, the chart, that means that you think everything's good and what they're doing is good. That's not what I'm saying. What I'm saying is AMC is trash. The dollar is trash. AMC had a massive short squeeze. The dollar is going to have a massive short squeeze. I mean, it's very clear. We're literally putting in new highs. We're threatening the previous 2002 levels. So the dollar has not been this bullish at this level since 2002. So what's coming up? Well, we probably retest these highs very soon. And then we'll see what happens from there. It blows my mind. People are so biased that they just can't. Their brains are just so tricked into thinking one way. The dollar is trash. They're printing too many. It's garbage. It's going away. It's horrible. World reserve currency status going away. The future, no dollars. Sure, I completely agree with all those things. But the thing that's the difference between what I'm doing here and why we're so successful is timing. Because you could be early and you're still wrong. You could be late and you're still wrong. Being right is just as much about timing. Just as much about timing. I mean, there's people been sitting out of the markets since 2000, waiting for the crash so they can buy it. Well, newsflash, you missed quite a bit of action. And why are they waiting? Why are they sitting on the sideline? It's the same thing over and over again. Well, this system can't keep going on like this. They're just kicking the can down the road. Sure, they 100% are. And I completely agree. The system cannot go on like this indefinitely. But none of us know when that time is going to come. And until then, we're basically just trying to call the top. And that does not work because the people in charge, the market makers of the world economy, liquidity, money, federal, governments and central banks, they are deciding. And those are all, that's the 0.1%. So it's in the vested interest, in the best interest of the 0.1% or the 1% to keep the system going as long as possible. Because if it all crashes down, they have the most to lose. They own all the stocks. They own all the property. They own all the everything. So they don't want it to crash. So they're going to keep kicking the can down the road as long as possible. So that being said, Tesla monthly chart, brutal close right here. A new lowest low monthly close in the entire uptrend. Below the 21. Not good. Could we still see a potential move back up to like 800 for a back test? We definitely could. Definitely could. And this is still ways off of confirming to the downside. I'll let you guys know. Obviously, I moved my stop up I was taken out of the trade at a slight profit, which is fine. It was worth a shot. It didn't play out or played out, but not as much as we wanted to. As long as we don't turn a winner into a loser, I'll turn a winner into neutral or a winner into a small win. That's fine, but we're not turning it into a big loss. So that being said, we'll reevaluate and we'll look for a new entry at our lower target around 535 if we get there. Obviously that's what we're looking for. Doesn't have to happen. But that's what I'm paying attention to for now. So, and again, if we see all of a sudden this just shoots back up to the upside, that's fine. I mean, we're still expecting that move. But the fact of the matter is we're de-risked at this point in time. And this is starting to look like basically, we have a leg down or a flagpole. And then we basically have, a symmetrical triangle. And typically when we see a symmetrical triangle, what happens is we basically see the triangle will play out in the direction of the trend 66% of the time, and it will play out opposite the direction of the trend 33% of the time. So we know basically, that's kind of hard to see because I have so many red lines on there already. Let me do this instead. We'll use our actual, it's like TradingView's like, we made these tools, why don't you use them? And I'm like, I guess. So depending on how we want to draw this, we have something essentially like this taking place. Now, arguably, it looks more like a descending triangle if we use the wicks as it has more of a flat bottom and a sharper slope to the top. If we use the closes, it looks just a little bit more neutral. So, you know, again, we could look at it both ways, and that's fine. There is no right way or wrong way, as long as you're consistent. Like, don't use the wicks on the top and the closes on the bottom. But this is more of a neutral pattern. The other way we had it drawn is just, you know, slightly more of a bearish pattern. But the fact of the matter is, it's pretty much bearish either way, because what we're seeing is the probability. Oh, whoops, sorry, I clicked the wrong thing. The probability is still favored to break to the downside because the lead-in was from the upside. So, you know, we see typically continuation in the direction of the trend. I'm like struggling here on this tool. I've literally changed 20 different things trying to make this stupid triangle yellow. It's been a long week, ladies and gentlemen, and we're just getting started. So that being said, we have our triangle right here. And again, you know, there's a lot of ways that you can evaluate this move. But if we just take the lead in and then we say, okay, when we break down, that's where we're likely to go. We can get a rough estimate of a target, which is somewhere around the 382, about 412. So, like, you know, you guys know we have macro targets along the way. So obviously we would expect a little stair step down to 537, then somewhere around like 413, and then we'll see where it goes from there. You also can look at like more conservative targets, like say for instance, we take the meat of the channel itself. Sorry, I should have done that the other way. We take the meat of the triangle itself, you know, from the one test from the top to one test to the bottom. It gives us a very conservative target if the break takes place, and then we move that out to roughly where we think it breaks, and then that's going to give us, you know, basically that initial move down. So both of these measure moves just give us two different targets. Doesn't mean we don't still just hit both of them. It's just a matter of, well, the first step's down is right here, second one's back up, and then third one is down lower. So, oh, that's what I did. I changed the color of this to yellow. Okay, I confused myself because I'm like, what am I clicking on? But yeah, that being said, you know, as long as Tesla's just bouncing around in here, I don't expect it to break in one direction or the other. But once it breaks, it seems more likely it gets to the downside. Probability says at least. So ARKK, not much to see here. EDU, still consolidating. As long as we're above 17, it looks okay. Still expecting a move back up to 26. And then I'll look to take profits there. China stuff. Looks like it's stopping out here short term. When we go out to our longer time frames and look what's happening, this just looks like our back test after the cross down. If we can't close back above $24 roughly on NEO on the daily, you know, we can't go higher because we have to get above the 8 before we can get above the 21. We have to get above the 21 before the 8 and 21 can have a bull cross, and we have to get the bull cross before we can be in a bull market. So, you know, we're at the bearish control zone. We have what looks like, you know, rejection of lower prices. We have a back test now. So if this acts as resistance and holds, we go lower. If we break back above it and consolidate, you know, maybe we start going bullish again. And, you know, maybe the U.S. equity market, Europe, etc., is just a couple months away from bottoming too, as China is sort of like, you know, just a few months ahead of everything. So NVIDIA, new lows, semiconductor space, obviously looking atrocious. Slightly off of our macro 382 internal retrace for the Fibonacci, 138. That's where I'm looking to enter for a potential scalp back up for our existing trade setup. Just waiting for that entry basically. But when we look at the breakdown, we have this 5-wave structure. We have retrace. We're at the 786 right now. So eventually what it looks like is taking place to me without getting too crazy on it. Well, it looks like this is just a move up, and we're now getting ready to do what I expect Bitcoin potentially to be doing. Which is essentially, okay, let's say, without getting crazy and doing the breakdown, we can look at this as a 1 and that's a 2, or this is the 1 and then that's a 2. And then, you know, depending how we draw it, and I'm just going to put it this way, but it could easily be the other way. I'm not going to go through and do all the calculations and everything, but we could essentially have something along the lines of this taking place, where we basically have a 5-wave structure, something through here. We have a now, you know, and then inside of the 5 is our 5-wave structure right here. And now we're correcting the 5th wave. We're coming in for a deep retrace. And then eventually we're going to go from correcting just that 5th wave right here to correcting all the way back down to the 1, you know, which is potentially what we're talking about for Bitcoin happening. So where does that take us to? Well, you know, that's our 382 macro, which tells us we are already able to viably fib from once we take out that 236. So now it seems likely we hit the 382, possibly the 0.5. We'll have to wait and see, obviously, what happens at the 382. If we get a bounce there, how high does it take us? Can we confirm back into a shorter term time frame bull run, etc.? But realistically, NVIDIA looks like eventually 105. But short term, we're very close to our 136 target, but very much still bearish on the longer time frames. And when we look at that monthly, we see pretty clearly hard sell, left the bullish control zone, all red histograms below the slope line, getting ready to cross 821 to the downside. Not unrealistic to think we could bounce back up to like 192 to try to stop the cross, but eventually, those targets start looking more and more realistic as we start to see longer and longer time frame confluence. Next, we have Apple hanging out at the 236 below our pre-Rona levels. Looks like we have basically broken down from support, retested, broke down from support again, retested, and now it looks like we're getting ready to break down again. We have already confirmed the 236 and the macro bull trend going back to March 2020 lows. Seems very, very likely. That we get a retest of the 382 next, which should act as support around 115. So we do see some bullish divergence playing out, but very, very poorly playing out, very weak. So maybe we get another drive of bullish divergence and then it actually plays out. Seems much more likely. Still ways away from confirming the 821 cross to the downside. We are sitting below the 21 though. So we have our first close below the 21, open below the 21, and then at the end of this month, 1 month from now, roughly, we will see if we're still below the 21. That is essentially confirmation to the market that we were probably going much lower. But Apple holding up much better than pretty much everything else in the tech space. So Google, we got the move back down here to retest that ascending support right here. We don't want to see it close below this. As long as we're above it, though, we would assume it's going to act as support. If we come back up here and retest enough times, eventually we probably break out and get our move back up. Unfortunately, we did slightly miss the entry on this trade as we were looking for a technical entry at the 382, and the market just slightly front ran it. No big deal. It definitely happens. We obviously know we have the split coming up on Google as well. So we potentially get another move back up here, maybe even the completion all the way back to 2,500 before the 20-to-1 stock split, and then likely go lower after that, similar to what we saw on Amazon. Actually, like almost exactly what we saw on Amazon. So hard sell signal, left the bullish control zone on the monthly, all red histograms, still blue slope line, but the histogram is below the slope, very close to confirming the 821 cross to the downside. Google could definitely be in for some pain. So Amazon basically just bouncing this horizontal right here. As long as that's holding up, it looks okay. But if we lose that level, definitely looking for some further downside targets. And if we zoom out here to our longer term time frames, like the 1 hour, nope, that's not right. Like the 1 month maybe, that's the one. 821 have already crossed the downside. Amazon looking very, very weak. We're very close on Amazon to retesting the 2018 highs. So not good, not good. And what does this tell you? If Amazon's the big winner in online marketplace, and it's struggling this bad, what is real life retail going to look like? What is online retail going to look like a couple months or years from now? Could be pretty nasty. Consistently lower lows on the monthly candles. Trend accelerating to the downside. All red histograms, red slope line. I mean, this looks rough. Already has the 821 cross the downside. Doesn't look good. Doesn't mean there's no hope in sight eventually, but seems likely that we're going to be coming down to retest the 200 exponential and simple. So, if you told me 6 months from now, hey, Amazon's at $45, I'd be like, oh, that's crazy. And you're like, you don't even believe it, do you? That's nuts, right? And I'm like, oh no, that's actually probably, our like bear case. So the 236 macro retest is 63. So, that's my like bull case. We come down to 236, find support, and then we just take off after that. Bear case realistically is probably like 31, 32, and then kind of like the base case is somewhere in between the 200 exponential and simple on the monthly. Not good for Amazon. Microsoft, so it got a little bounce up here and holding at decent levels. Obviously the trade setup is like halfway played out. Not like some amazing crazy setup that's going to like change your life, but 20% is always nice off of that bullish divergence, off of a potential retest or backtest of the, what is now bearish moving averages. Oops. And then if we just look at the macro out here and we take a fib all the way from 2009 low on Microsoft, basically just went parabolic after that. So the real confirmation that we are essentially confirming this is our fib to be looking at is if we get to that 236 macro in orange at about 167, which is still a ways down for now. We're currently bouncing the 2020 low, the Rona low, bouncing off the 382. So, essentially that lines up, the 786 of this retracement lines up with the 236 of the macro retracement. So if we don't get that low and we bounce the 0.5 or the 618 and then cruise to the upside, well, we have invalidated the macro fib because we didn't make it to 236. And then, we likely go back to new all-time highs and just keep on ripping. But, still a lot of price action for the market to tell us one way or the other. All right, let me jump in the chat real quick, see what's going on with you guys. What's up, Karma Betty? Good to see you. Hey, bro, how are you? I'm good, man. How are you? How would you compare the upcoming recession to the previous ones? I'm assuming you were talking about. I mean, what we're seeing on the charts, the technicals right now are telling us that what we should expect is a 2008 or 2000 style recession or worse. But I would just right now assume that we're going to get a recession at least as bad as 2008 or 2000. Now, that being said, in many ways, the 2000 situation was United States. Now, granted, lots of other people outside the United States were invested in tech, but the tech.com bubble burst was essentially a United States-centric event. So people that live in, participated in, tech bubble, and then it bursts, they suffer. So not necessarily a world event, nearly in the same way, or destruction of wealth. The 2008, bursting of, the housing market was in many ways, again, a United States-like centric event. But again, lots of people, it was worse because the dot-com bubble burst affected a small group of people that were in like tech and speculative like companies. The majority of the United States wealth of your average like consumer or middle class person is tied up in their real estate, their home. So the 2008 event affected a lot more people, a lot worse. And then on top of that, it was actually a worldwide event as well, as it was essentially the global financial crisis. So the destruction there was on a like dollar amount in trillions scale, much, much worse than the dot-com bubble was. And it affected a lot more people, and it affected a lot more people around the world, or average people, as opposed to just like stock market and, investors or speculators. So this one that we have now is very much a world event, as we're seeing the biggest GDP countries in the world, the top countries, going into recession. Big countries by population and by GDP. So, if obviously Europe, China, and the United States all go into recession at the same time, that is very, very bad. And the amount of wealth that has been destroyed globally in the trillions, far more than we have ever seen, like in dollars or in, currency. Now, that being said, if everybody goes into a recession all at once, the best way to probably get out of that recession is, well, one, inflation has to go away first. But then after that, the best way to get out of a recession historically is probably a war. Probably war. So arguably, the best case scenario and the worst case scenario are directly tied together. Because best case scenario, we have a war so we can get out of the recession that's coming. Worst case scenario, we have a war and that's it. It's just shitty. We don't want wars. So we'll see what happens. But, right now, the way everything looks, it seems likely we go into a really bad recession. Eventually, inflation goes away. The destruction gets so nasty that, eventually governments or central banks have to pivot and then try to print our way out, I guess. Maybe we see the next industrial revolution as countries start retooling manufacturing as we go away from this globalization environment and go back more towards a nationalization environment or nationalism. Seems likely, and it doesn't have to be a bad thing. But also, it's very clear now that the supply chain is extremely fragile and that we have sacrificed quite a bit of resiliency for profitability. And going into the future, I don't think that will be the case. So I think it's more likely than not that we actually sacrifice some profitability for some resiliency. So it means things are probably going to be more expensive in the future. So even if we don't see, these bouts of inflation like we've recently seen, I think realistically, the struggle that we have known for the last, 20, 50 plus years of, fighting deflation by intentionally creating inflation, because, obviously technology is inherently deflationary. Population growth is slowing, which is inherently deflationary. There's lots and lots of other things that are inherently deflationary. But now we're putting in a potential macro inflationary environment, because the truth is globalization is massively deflationary. So if we stop seeing globalization, or it slows, or we actually go more towards like nationalism, realistically, that might kind of balance out the deflation issues of tech, at least to some degree. So it doesn't have to be all bad. I mean, my actual bull case scenario for the future, at least for the future of the United States and many other countries, is essentially something like that. We finally say, okay, we're tired of just getting everything made halfway around the world, because when shit hits the fan, it sucks. So we're going to start making a lot of our own stuff again. Maybe we start, American steel again, American semiconductors, American, energy independence again. We start focusing on all these things, and I would expect other countries to do the same thing, or continents, and, in Europe's case, or UK or whatever, China, everybody wants to be a little more resilient in the future. So that's going to be actually good for the people of those countries. So there's a lot of factors, a lot of strings, all pulling on what's going on at the same time. And we don't know which of those strings is going to pull most in that direction. But by looking at those, and looking at how they can affect each other, we get a much better idea as to what's to come. And in my opinion, short to mid-term, the next 1 to 5 years, things are probably going to be pretty nasty. So that being said, let's take a look at gold. So gold has put in, basically threatened the lows, put in a new wick low right here. We came back down and threatened some key support levels. We have basically come down below levels we want to be at. We have lost key support. Doesn't look good right now. Does not look good. Doesn't mean it can't look good in the future, but doesn't look good right now. When we look at the weekly, obviously it does not look good. It seems likely that we're coming down to 200 exponential or simple. And then when we look at the monthly, this is basically what we talked about. Worst case scenario. We close down here at the lows, and then, a month or two from now, we get a close below the 21. And we know what happens after that. We start threatening to cross down. The last time this happened, we finally got our first close below 21. We got one push back up, failed to cross it back to the upside, and then full-on capitulation takes place. So, the next monthly closes below here, possibly a push back up, try to stop the cross, and then probably capitulation happens. We see the exact same signature here on the TDMACD. If you're not using the TDMACD, it's free, so just go get it and use it, and you'll just be a better trader or investor automatically, I promise you. Well, unless you don't understand how it works, then it probably just won't help at all. But there's a video that explains it, so there's no excuses. Ignorance is not bliss. So we push back up here after breaking down. The slope is still blue here, which is one of our strongest rejection signals, and then we just melt down. We break down here below the blue. We come back up. It's still blue. We retest it. We fail to break back above it. That's one of our strongest rejection signals. So are we 1 month away, 2 months away from gold getting really, really nasty? It seems like it. And you're like, but the fundamentals. And I'm like, look, nobody cares about fundamentals. Short term. Silver, disgusting. You disgust me, silver. Ugh. It's like the metal that got an STD. That's how disgusting silver is. Ugh. Oh, no, wait, that's palladium. Well, silver's got something, too. It's got something. And I'm not talking about a rash. I'm talking about some permanent stuff, okay? Oh, my God, disgusting. Well, we did it. We hit another target perfectly. Everybody else was calling for $50 silver, $100 silver, $1,000 silver. Silver is amazing. The silverbacks, the gorillas, the Wall Street silver guys, the silver of walls of whatever. All these retard groups. Oh my gosh, that's crazy. You guys have all these group members, tens and hundreds of thousands of people, and all it takes is just one random guy on the internet with a channel that doesn't even have 1,000 subscribers to just prove all of you wrong. Oh my God, that's so crazy. I guess the fundamentals lost and the technicals won. So teens, I said silver in the teens, and where we're at right now, $19.77. Silver is a teenager once again. Congratulations, we did it. We were right again, obviously. Yeah, that sucks. I mean, it sucks for people that like silver. I mean, I own lots of silver, but also, I mean, my cost basis is much, much lower. I didn't buy all my silver at $30 or $25 or $20. So I'm okay. And also, I'm not using silver as like a speculation. I'm using it as a store of value or schmuck insurance against the complete meltdown of society. But that being said, silver looks like trash, as expected, as predicted. It's playing out. Congratulations, we did it. We ruined an entire another, group of people. I mean, we didn't do it, but the market did. So yeah, silver's garbage. It's trash. Obviously, it's going to zero, straight to zero tomorrow. And if that doesn't happen, I'll rethink my prediction. But no, realistically, I mean, it doesn't matter. We melt down. We'll keep melting down. We knew this was coming because the gold-silver chart told us. And we know the gold-silver chart's not lying. So that being said, 1750 probably, 18. I mean, there's a lot of support around these levels, but this looks disgusting. It looks nasty. We're retesting the 200 simple right now. Do we get back down to like $17, $18? Yeah, I mean, we could get back down to $14, on digital fake silver on the internet. And that's a great way to speculate and then turn it into real silver long term. But right now, this chart's disgusting. Now, granted, it's like the biggest cup and handle ever in all of existence, going back to 1980. And realistically, we can just come all the way back down here again and then just start creeping back up and then eventually get back up to 50. This could just be a stall in the meantime before we go much higher. Now, you guys know I have very high targets on silver. And I'll do another follow-up video because I haven't done one for a while. But somebody was surprised because I'm always mean to silver that I have targets of like $50, $90, and then, in all reality, like $250. Yeah, I mean, I just am mean to assets when their charts look like trash just because it helps to portray my message. I can understand how people are like, well, you hate crypto. Why is your channel Crypto Trend Trader? I'm like, well, I don't hate crypto. I mean, I just hate how the charts look. Well, I mean, most cryptos I actually do hate because they're trash. But, I mean, I don't even discern which ones are which unless it's a really, really shitty one like XRP or Dash. So, yeah, that being said, silver looks terrible, as expected, as predicted. And how did we predict it? Well, I mean, look at the gold-silver chart on the weekly. It's confirming into a bull run. So what does that tell us? Gold is going to continue gaining value compared to silver. Oh, and we hit 90. Perfect. We did it. We hit our target. Awesome. Congratulations. We hit the 0.5. We did it beautifully. Next target, 618. So 97. So if we keep creeping up past 91, I'll see you at 97. 97 silvers to 1 gold. So every day that you're holding silver and not holding gold, or you're buying silver and you're not buying gold, you're losing buying power in comparison to gold if you're owning or buying silver right now. Historically speaking, the average is more like 40. So people are like, well, that's all the more reason to buy silver right now because the gold-silver ratio is historically like over double what it usually is. Sure, you're totally right. And that would be a smart thing to do unless we go up to 100 or 120 or, new all-time highs like 130. Then you'll be like, oh man, should have bought gold or waited to buy silver. So, I mean, if this is telling us that silver is losing value compared to gold going into future, which is what it tells us when this is in a bull run, which is very clearly confirming into a bull run, going parabolic, we know that that means most likely gold is going down and silver is going down much, much faster. And obviously that's what's happening because silver went down from $30 and now it's at $19. Gold went down from a little over $2,000 and now it's at $1,800. So, it's very clear what we expect and what we're seeing take place. The monthly chart, 821 have confirmed to the upside. it looks like gold is going to go on a bull run in comparison to silver. So it looks like gold and silver are probably both going to be going down. You know, we're literally in the bull market or bullish control zone. Came out of the bearish control zone, hard buy. Crossed the 821 to the upside. Very bullish. All green histograms above the zero line, above the slope line, and the slope line has officially changed blue. So on a monthly chart, the gold-silver ratio is as bullish as it gets. I don't have any indicators left to make this more bullish than it is. They all are already very, very bullish. Literally the only thing that the gold-silver chart could possibly be doing right now that would ever be more bullish, like anything that we could even think of, that we could even fathom as a possibility, is if it was already putting in new all-time highs, which it's literally on its way to do. So is it going to happen? We don't know. Could put in a lower high. But it sure looks like it's getting ready to put in new all-time highs. So if you thought it was a good deal to buy silver when it was 90-to-1 silver-gold ratio, you're going to think it's a really good deal to buy it when it's 130-to-1 silver-gold ratio. So, you know, that's what the chart's saying. That's what the chart is telling us. And you know what? I trust it. But the fundamentals. ACB revisiting the lows. I mean, you know, pot stocks, I just expect them to continue melting down. But at this point in time, you know, they're, in the words of Kathy Wood, in deep value territory, in my opinion. Looking for Tilray to put in a new all-time low. And that's where I'm really looking to start buying in Tilray. I really like Tilray's cash flow. Hexo, very weak. New all-time lows. Having some financial issues. So I'm not nearly as bullish on this one in relation to the space. I think the most important thing is don't worry about being right. Diversify. You know, always. CGC. So we took out the 1.618. I did take a small entry here for a, you know, not really even a trade position, just like a set it and forget it, sort of like quote unquote investment. You know, very speculative investment, obviously. Anything in a non-profitable company, you know, during these times right now. So it could go very, very much lower. I mean, this thing could literally come down to new all-time lows and get cut in half. Cut by 66%. So it could go from, you know, roughly $2.80 right now down below $1. And I would not be surprised, and it would not change, you know, how I look at this. So be prepared for that if you're just going to start buying falling knives. Just a heads up. So Sundial holding up a little bit better. All-time low is closer to like 14 cents. We're at like 33 cents now, so it could get nasty. Trading very, very technically. We bounced the macro 236 and 382 in red, and we're also bouncing our shorter term fibs in green as well. So again, fully just expect slinky theory to continue playing out. We're just going down a stair, the tail whips back up, then we go down another stair, tail whips back up, down another stair, tail whips back up, another stair, tail whips back up, another stair. I don't expect this to stop just melting down. You know, once it starts showing some signs on shorter time frames, we will definitely be paying attention to that. But we're seeing no signs of bottoming in pot stocks anytime soon. But again, I'm not necessarily worried as much about buying the bottom on pot stocks as I am just slowly, you know, putting some money to work in that area. Because long term, you know, we're looking for like a 3, 5, 10 plus year time horizon, and the risk reward is just ridiculous. You know, we're looking at like 20, 50, 100, possibly set rather, like 1,000 to 1 or 100 to 1 rather ratios. You know, potential 1,000% upside, potential 100% downside. So 0 or big ballin'. All or nothing, so to speak. So CCJ, Cameco. So we have lost the 200 exponential and simple. Starting to show some weakness as expected, essentially confirming into a bear market on uranium. Trading pretty technically for right now, but I'm not looking to bite at this point in time. I'm looking for slightly lower targets, but I'm getting to where I could probably dabble and redeploy a little bit of my uranium capital from when we took profits most recently. That being said, UEC, again, showing some strength, trying to move up here, but closing at new lows, so not particularly bullish. New lows on UROI, backtesting the 382. Seems likely we get that 0.5 entry at a $1.82. So really keep my eye on these. And then quadruple UPL, you know, bear market confirmed. Looks like we're going down lower. Looking for an entry around like $4, maybe $3. Right on the dot pretty much there. Wheat futures melting down. But wait a minute. That doesn't make any sense, right? Because there's no food and there's no gas and there's all these issues. And this is definitely not just rampant speculation causing these like price changes. Definitely not, right? Right? So I guess we'll see. But as far as I'm concerned right now, we are basically trading very, very technically on these fibs. We had our 786 or 236, depending on how you draw this, because it's basically a double top if it's internal or like wave up. But essentially, we're hitting the 618 right now, which is our macro target. So I would expect to bounce around this area, the 846. But realistically, we could see 725, the 0.5 down here, slightly lower. This thing's getting pretty oversold though. Now, the most important thing to pay attention to, we're always talking about parabolic trends, parabolic trend lines, and, watching like the parabolic moves develop. So here we have basically like an initial kind of push up here. We're finding support along this line along the way, and then we start to diverge away from that line. So we're not making it back down to it for like those retests. And then we start to build like a little more aggressive of a slope to the upside. And then we see, I'm just making the colors different so we can see the trend accelerating. And then we see, obviously, we start finding support again here very aggressively. And now basically what has happened is we are now, we went absolutely parabolic here. So, we talk about this all the time, the progression of a parabolic trend. The slope is decent. The slope is accelerating. The slope is accelerating extremely fast. And then finally what happens, the blow off top or just the straight up move. On a longer time frame, this is just a straight up move. And then what happens, we retest or we get a little blow off top. We put in a lower high and then we lose support and we melt down. What does this look like? What does this pattern right here look like? Exactly. Why isn't anyone saying anything? No, I'm just kidding. There's a delay, and also you guys don't have microphones. So I'm going to tell you, I'm going to give you a clue. Just in your head, look at this right here, and tell me what this looks like. Take out this part right here. Delete out this part right here. We don't know what's going to happen in the future. So let's just scroll this over, and it's like, this chart looks kind of familiar. What does it remind you of? Something went absolutely parabolic, put in a high, consolidated for a while, put in a lower high, and now it's back down at support. Let's just go and look for one specific chart that looks a lot like that. Maybe it won't happen. Maybe it won't. But it looks a lot like our oil chart right here. And it just looks like we're right here. We're coming back down to retest that flat support. And the daily 200 exponential are simple. And after that, we get that full-on meltdown. Now, it doesn't have to happen. It does not have to happen. But it's a very, very common topping pattern. And when we look at these two next to each other, and we see basically, I'm going to delete or cover this up. When we see these two next to each other, I mean, this looks very, very similar. We have a big lead in, a blow off top, a lower high, consolidate. We take out the previous lower high, but we put in still a macro lower high. We blow off top, we consolidate, put in a lower high, move down, slowly melt back up, and then we put in a lower high. We take out the previous high right here, and then we come back down and start retesting support. So what's going to look like? Well, eventually, what happens? We come down and we retest the 200 exponential and simple. So that's right around our $100, which is our price target. And then what happens after that? We lose that area and we see the meltdown take place. So again, it doesn't have to happen, but it sure looks a lot like a very, very clear topping pattern that's playing out exactly right now in wheat as predicted. Well, everyone's saying wheat's going to go higher and everyone's going to starve and there's going to be no wheat and blah, 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 blah. I don't give a shit about fundamentals. I mean, I do, but not when we're looking at technicals. So technically, wheat looks just like oil, just a couple weeks ahead, maybe months. So lumber, we got that massive blow off top on lumber, eventually came down, put in a lower high, double top, broke down. Technically, I've still put in a higher low. So as long as we stay above, this higher low basically at 460, lumber still looks okay. So that being said, we have like an ascending support that we bounce right here, which is our macro 618. So we'll see what happens. But realistically, it looks like we're probably going to come back up, retest our yellow 0.5 or possibly our green 382, and then probably top out somewhere in that region. Realistically, I don't know where lumber is going to go long term, but if we go into like a big recession or whatever, the demand for lumber and new homes and all that stuff, and if rates stay high, the demand for, new homes and lumber and all that. I mean, it's not good. So realistically, it's not unrealistic to think that lumber may have further downside. But right now we're at support. So I'm not like looking to speculate on further downside. I'm waiting for it to come back up. And then I'm looking for essentially, another lower high retrace, because right now it just looks like a giant triangle. We have a couple touches on top, a couple touches on the bottom. So we'll see what happens. Maybe we get a little overshoot and we get a move up to 618, somewhere around here. That's definitely a possibility. I don't like having gigantic areas as like targets. This is like a pretty big target. But that's what we're essentially expecting. Some kind of move back up here and then move back down and then just continue filling out the pattern. The longer, and then finally one day we get a break in one direction or the other. We obviously can't speculate necessarily on that break, but we have a bullish lead in. So typically we'll break to the upside, 66% of the time. So that is what I'm seeing on lumber. All right, so we did all the rest of these requests on Friday, and went into like a little bit of detail on the monthly and everything. And we basically, like, the stream ended like 2 hours before the close. So there's really no reason to look at them again. So we'll just look at them again on Wednesday, because obviously nothing happens over the weekend. So we have like 2 hours worth of price action we haven't talked about. And the monthlies, spoiler alert, the monthlies look like shit and not much change. So Bitcoin and cryptos. Let me jump over in the chat real quick. Calma Betty says, yes, the previous ones. Thanks. Honkiness says, does oil usually follow the market down in a crash, recession, etc.? Yeah, think about it like this. If oil is energy, and the better the economy is, the more energy we need, because productivity is directly linked to the economy, and productivity is directly linked to energy, because through the use of energy, we increase our productivity. One would, rationally say that as the economy slows, so does the consumption of energy. And oil is basically the lifeblood of, the economy of the world. So the same way, like, food and water are what humans use for energy to thrive. Think about it like this. If you're literally just going to lay in your bed all day, you're probably not going to use much energy. So you don't need to take in that much food and water. But if you're going to go on a, 10-mile hike, you need to fuel up. You need a bunch of food. You need a bunch of water, because you're about to burn a bunch of energy. And, essentially the way your body works is, energy in, energy out. So if you have a deficit of energy, you're not going to be able to continue for a long time like that. And the same way, if you have a surplus of energy and you just lay around all day, you're just going to get fat and lazy. So, that's essentially the way you look at the economy. So if the economy is going to slow, think about that as the person that's just laying around in bed. They're not going to use up that much energy. Therefore, they don't need that much food and water. So the economy doesn't need that much, oil or coal or, whatever we're talking about, nat gas, etc. But if the economy is booming, that's essentially like an expansionary period. We're using up tons of energy because we're manufacturing and we're moving stuff around and we're traveling, and and that's the economy going on that 20-mile hike. So it's going to need a ton of energy to sustain itself. So that's how you have to look at the way energy corresponds with economy and growth, and acceleration versus deceleration, or recession/depression. And then obviously stagflation is really bad, because essentially the oil is really expensive, and then on top of that, growth is slowing. So eventually the oil prices will come down as demand comes down. So essentially, like, that's the old saying, the best cure for high prices is high prices, because eventually it kills demand. Because lots of people will just get in their car and drive around when there's $2 gas. But when there's $10 gas, you best believe people are only going places they need to go. They're not just getting in their car and just, driving around sightseeing. No, hell no. They're doing anything they can not to get in their car. Matter of fact, they might even just park their car and get a bicycle or start walking around instead, depending on how bad it gets. All right, so hopefully that give you a pretty good idea what to expect, honkiness. And then obviously when we look at the oil chart, we see essentially when we see those monthly sell signals and those hard sells come in after those like big oil price spikes, those lead us into the recession, every time as well. We have like 2000, 2008, 2014, 2020. We see like those big oil spikes and then the hard sell signal on the monthly, leave the bullish control zone, and then we start, going down. And that's typically, right around when the recession starts. So 100%, I agree with that. And as a matter of fact, the reason that the energy spike is so important, and that's our fourth horseman, is because literally every time we have one of these big economic events and slowing, oil prices spike to the upside first. So that was literally our fourth horseman, the one we were waiting for, going into basically like last year / going into this year. And obviously that's what we saw. It exploded to the upside. And people are like, yeah, but it's because of the war. Yeah, but it's because of this. Yeah, but who gives a shit? Because we didn't need to know any of that. We didn't need to know there was going to be a war. We didn't need to know there was going to be sustained inflation. We didn't need to know any of that. All we had to do was look at the technicals, and we were ahead of the game every time. And that's why it's so beautiful. And that's why I developed the, four horsemen strategy. All right, so on to the crypto. So Bitcoin futures chart did nothing over the weekend, obviously. So we closed and then reopened at that same level. So obviously, Bitcoin just did nothing. We still have some potential bullish divergence here developing as we're continuing to put in new lows. Looks like we want to come down here, put in a new low again, and maybe get a third drive of bullish divergence. And then we can really talk about potential reversals or something. But this still looks terrible. It still looks terrible. We're still expecting, lower lows. So we have broke down from key levels, our blue support right here, and, the 1.618 fib extension, and also our macro 0.5 fib in white is around 1680. So we're looking for that target. But realistically, somewhere around like 14.5, 14.6 is really what we're looking for, like on this next leg down, assuming we do get it. And then if we just go to our weekly, we see basically what we have right here, and we just talk about like the acceleration of the trend, like on, whatever the hell we just looked at, I can't remember already. But essentially, look at it like this. This is our 2018 low, and then we come back down, we find support, and that's our little like, support, ascending support right there. And then the trend starts to accelerate, and then we see a third level of acceleration as it basically goes parabolic here, and then we get the blow off top. We retest the previous ascending support line, actually picks it up, takes us to a new high. We put in our bearish divergence, then we break down from that one, retest our horizontal support, put in a lower high, break down from that one, retest our previous ascending support line, and then we break down from that one, and now this is when things get nasty. So, and again, same techniques over and over and over again. We have very clear rational reasons that we're looking for certain things, that we're looking for ascending supports, horizontal supports, etc. And we just are super consistent, because that way we know if something's not working regularly, we're doing something wrong, we need to take that out. If something's working extremely well, we need to weight that slightly more because it's giving us great results very reliably. And these are some of my, let's be real here, okay? Most people that figure out how to make the market their bitch, how to like master the market and do technical analysis and stuff, most people are not coming out and revealing all their techniques and secrets for free. Because once you find something that works, you just sit on that and you hide it away like, Golem in the Lord of the Rings. My precious TA, no one will ever know my methods. But that doesn't benefit me. I don't get anything out of just winning by myself quietly, like without anyone else. It's much more fun to win together. And this community is all about, creating winners. And obviously I choose to give away everything with hopes that it will benefit other human beings, because honestly, most people do suck for sure. But I like the community and I like being able to share this stuff with you guys. Now, will one day I write a book and sell it? Sure. Will one day I put together a course and charge for it? Sure. But in the meantime, I like being able to give everything away, essentially for free. And the very few things that I don't give away for free, not because I don't share them with you. I still talk about it. I still show you my strategy. You could easily, do whatever you want on your own. It's just a benefit that I give to the community for showing me, support. So, that's what it's all about. Because obviously I could be doing better stuff with my time than coming on here and doing multi-hour live streams and putting out videos all the time and giving away all my trade secrets. Sure, I could definitely find something. But I enjoy this. I enjoy the community. I enjoy the impact. I enjoy the, group and everybody together and having fun and posting up memes and, posting up trade setups and seeing everybody grow and seeing everybody's success and, other people pointing things out to me that I didn't even see, all learning from each other and continuing to learn and be passionate about something that can financially benefit us massively into the future. That's what this channel is all about. And you know what? So far, it's been a fucking success. I love it. Very, very happy with where this channel has gone in the last couple of years. And I can only imagine what the future looks like. But that being said, the roadmap is playing out perfectly. These markets are doing exactly what we expect. Again, this is the nastiest candle. Arguably, we've had a couple other big ones, big and thick ones, and red, of course. But the problem is, we have literally no wick at the bottom, which means we sold off for a month straight, completely melted down, and no buying pressure came in whatsoever. We literally closed at the lows. So the likelihood that we ran out of sellers is very, very low. The likelihood that we ran out of time is very, very high. And I talk about that. When we close at the lows, it's not because we ran out of people that want to sell. It's because the candle ended because the month was over and there's probably still more people to sell. We just need to wait one more month and see what happens. And it's very obvious we have this one candle and then one on the other side on the spot market, obviously, which was our blow off top at 20K down to basically 14K. And then we have a wick here up to 14K. And then we have one candle from 14K to 20K. So we are very close to just wiping out another big block and going down to like 14. 13.7 here, 14.5 on spot, somewhere around there. It doesn't matter. We just crossed 821 bearish and disgustingly bearish cross of the 821. Obviously, this never happened before on the futures chart. So in case you're wondering, am I now all of a sudden bullish on crypto? No. If you stand on your head and you turn the candles from red to green and green to red, then technically I'm bullish on crypto right now because I think it will continue to go up, but we're standing on our head, so really it's down. So yeah, not good. So the Bitcoin spot chart, again, we see some bullish divergence here, but very weak, trying to build up some momentum here. Histogram above the slope line. Is this just going to be another bearish reset like we saw right here before we melt down again? Well, until we get above that 8 and we start closing a daily above the 8, and then we can come retest the 20. There's nothing bullish on this chart right now. Absolutely nothing. Because the momentum is, in my opinion, the indicator oscillators are lying to us. Not because they're doing a bad job, but because whoever's making the markets is making them look a certain way. Which is fine. It's called painting the tape. It's happened since the beginning of time, and it will continue till the end. And if you're painting the tape, it's market making. If someone else is painting the tape and you don't like it, it's manipulation. So it's all how you look at it. It's all about, perspective. Now that being said, the daily looks like it's getting ready. Stochastics are rolling back over. Looks like it's getting ready to have another bear cross and probably revisit the bearish control zone. Looks like we'll probably lose this slope line again and melt down. And then again, we're looking for a new low, maybe 16, maybe 14.5, and then possibly a third drive of bullish divergence. So if we can get the histogram up as high as possible before the meltdown happens, and then we come down, all that needs to happen is we just need a higher low on the histogram and a lower low on price, and we can get another 3 drives of bearish divergence just like we got right here before we got a massive move back to upside. Now, does that massive move take us to new all-time highs? No, of course not. Obviously not. But maybe. But regardless, it's going to be a nice trade if we could participate in it. Not as nice as this one because we were still bullish, but triple bearish divergence plays out typically pretty nicely. Maybe that'll be our next reversion to the mean retest up to 34K, possibly if it sucks, maybe to 28K. But I mean, if we get an opportunity to enter between 14 and 16, and then it rides up to between, 28 and 32, that's a 100% move back to the upside. And we're not getting crushed on the way down like all the rest of the, chumbag losers are. The hodlers, I mean, I'm sure they're good people. They're just stupid as fuck. They're like, yeah, but if you look at every person that ever bought Bitcoin and then you wait 4 years, they will always be in profit no matter what. And if you don't understand that, you're just dumb. And that was true. That was true. Right up until recently when we took out the previous all-time high. That was 100% true. And I would agree with you. But now, one more thing has been proven false as expected. So we have proved time cycle analysis, like the lengthening cycles, proved false. Okay? So everybody that said, oh, the lengthening cycles, well, they're fucking stupid and they've been proven wrong. So sorry about your luck. You're dumb. You're wrong. Admit it. So check on that one. We win. So that's a W for us. So next, we took out the previous all-time high, as expected, as predicted. So once again, if you bought in December of 2017 and then you waited 4 years, technically you were in profit. You were in profit still in December of 2021. Unfortunately, since then, price action has melted down and taken out the previous all-time high. So now you're no longer necessarily in profit. Now, granted, we're still at 19,000. So, you maybe are upside down $1,000. Not a huge deal. But the fact of the matter is, we have violated that level. And again, proven another one of the bullshit crypto theories false. That if you buy and wait 4 years, you'll always be in profit and you'll never go that low again. Proven false. So congratulations. You're wrong again. Another W for the crypto trend trader team. Congratulations. And then the third one that we've proven false was on-chain analysis. So all the people that were talking about on-chain analysis through here and the on-chain analysis and we're going higher and there's the chain activity and they're moving the coins to the exchanges and they're moving them off the exchanges and there's record lows of people and the liquidity and every on-chain analyst is now, wrong. They're wrong. They're proven wrong again. The top two on-chain analysis are a bickering fucking nut job. Sorry, Willy Woo. I used to respect you, but you're, not even, can't even tell what the hell the guy's saying anymore. He doesn't even make sense. Everything he said has been proven wrong. And then the second top on-chain analysis is a college student. Like, he's living in a dorm. His parents are probably paying his bills. And he's the top respected on-chain analyst. Get the fuck out of here, you fucking morons. You stupid idiots. Again, proven wrong. Because if they couldn't see this coming, and we could, well then what the fuck good is on-chain analysis? If you can't see this coming, if you can't see a move from 70,000 to 20,000 coming, what the fuck good is on-chain analysis? If you could lose $50,000 in value and not see it coming, if you can literally lose 73% of your assets value and on-chain analysis cannot see this coming, what the fuck use is on-chain analysis? It's none. It's useless. It's useless. It's garbage. So that being said, no offense to Willy Woo and, college boy. But the fact of the matter is, you guys are fucking morons. Sorry about your luck. So that being said, what do you expect to happen here? We've laid out the course pretty clearly. We have also done something disgusting on the weekly spot chart. We have not only closed below the 200 simple, open below the 200 simple, close below the 200 simple, open below the 200 simple, close below the 200 simple, and then open below the 200 simple again. Something that we have literally never done in the entire history of Bitcoin. So once again, something disgusting. Took out the previous all-time high, closed below the 200 simple. 200 simple is getting ready to cross bearish. It is literally almost flat at this point in time. 200 exponential already bearish. 200 simple about to cross bearish. Absolutely disgusting. Does not mean we don't get a back test to 22 or 26 at some point in time. But this looks gross right now. It looks gross. Now, I do expect a back test. But the question is, do we back test from 16? Do we back test from 14.5? Do we back test now? I don't know. We don't know that much. But this looks disgusting. Very, very bad. And just to point out one more time, I'm not trying to be biased or anything, but we know that previously, I'm going to switch over to the monthly real quick. Previously, when we confirmed the 821 bear cross right here, that monthly candle after the confirmation or at the confirmation was the absolute bottom in 2015. Here we melt down, we confirm the bear cross, and that cross, that monthly candle where we confirm the bear cross, was the absolute bottom in 2018. And now here we have crossed down bearishly, and that could potentially be the permanent bottom, the lowest low in June of 2022. So what do we need to know if this is, now granted, I do not give much, credence to this. It's just something specifically that I pointed out, okay? I'm not like trading off this like, oh, the bottom's in now because the bear cross just happened. And the last 2 times it happened, it was the absolute bottom. We're going to know really soon, because if we go lower than the wick down right here, well, we've invalidated that theory, because previously even the wick was on that same monthly candle. So we know if we go any lower than, 17.8 or whatever, a main exchange like Bitstamp or something like that, what was it, 17,592. If we go lower than that, we can just throw that right out the window because it's been, invalidated. And again, I don't give much credence to that at all. It's just something, just an observation. And then when we look at the chart here, left the bullish control zone, hard sell signal, cross the downside, bearish divergence on the monthly, followed by a meltdown. How many other things did we just point out bearish divergence on a monthly? Well, careful of that meltdown isn't coming. All red histograms, red slope line, below the zero line. Very, very, very bearish right now on crypto. Very bearish. I fully expect by the end of this month, there's a very good possibility we're down at like 13,900, 14,000. So, and if you didn't look at my macro video, to see the targets to the upside and targets to the downside, I have targets to the downside as low as, $1,000. And I have targets to the upside as high as $3 million. Okay. We don't have to hit all of them. We don't have to hit any of them, but, fully just expect the trend to continue playing out. So altcoins, let's be real here. ETH is holding on for now. Daily looks okay. We're seeing some momentum, some bullish divergence, but when we zoom out to the monthly, Ethereum looks nasty. Cross down to the downside, 8 and 21 on the monthly, looks absolutely disgusting. Very close to entering the bullish, bearish control zone. All red histograms, red slope line. I don't see a bottom in sight anytime soon for anything really. I promise though, I will let you know if I do. Bitcoin dominance on the weekly. So again, we're still back inside of that channel for now, which is technically bullish for altcoins. So does that just tell us how stupid money is in the crypto space? Yes. The answer is yes. As long as people are still buying altcoins and they're still gaining dominance compared to Bitcoin, as we melt down, that is the stupidest fucking thing I've ever seen in my life. Which is fine, because honestly, it's okay if everybody gets wiped out for doing dumb shit. That's okay. It's actually good for the market, because one of two things happens. They either learn from it and stop doing dumb shit, or the market helps them go away for good. Because, you can't just keep losing and buying the dip and buying the dip and buying the dip when stuff just goes to zero. So we have an ascending support line here on the weekly chart. As long as that holds, there's still a likelihood we break back up here and continue up to our target, which is the remainder of the measured move and the top of what I'm expecting, the potential 1 reversion of the mean, 200 exponential and simple on the weekly retest. If we break down from this area, we'll have to reevaluate, and then we'll look at this descending support line in green. So as long as this holds, which I suspect it will, it looks okay. And what is this going to look like? Well, if this starts to move back to the upside, it means, Bitcoin is down another 10% and alts are down 20%, or, some equivalents of that. So total market cap, not sure why I have this on the daily. I usually keep just these two charts on the weekly, just because the daily, nothing really changes. But we have melted all the way down to 200 simple on the weekly for crypto market cap, 850 billion, which was obviously our target. We have a slightly lower target, the previous all-time high, and then close high potentially, somewhere around 750 billion. And then realistically, we probably end up, if you go out to the monthly close was like 538 billion back from 2017, 2018. So that is the purple line here as well. And seems pretty likely. Seems pretty likely. So it does not look good. This is full on melting down as expected. Exactly hitting our targets. Trading very, very technically. Absolutely beautiful. So Matic, again, melting down. This one's holding up okay. It's nowhere near that initial push down here was. But, that doesn't look particularly good to me. The daily looks like it's getting ready to cross down. This looks like just a back test on the weekly of the 236, which acted as resistance. So now we go to the 382. Matic, I'll see you at 20.4 cents. Seems very likely. And then if we look at the monthly, we're very close to confirming the 821 cross. So again, not good. Not good. Avalanche looks very, very similar to Matic, but obviously a little deeper of a retrace. If we go out to the monthly here, I mean, we basically just round tripped our previous fib down here from like 950. So that's gone. We're not even using that anymore. So now we're just using the macro fib from the low back here in December 2020. And we are basically right about to hit the 618. So expecting support around like $13. Maybe just slightly sub 10 is a possibility. So Solana, again, looking very similar. Seems likely we get the 382 retest at about $23 very soon. The daily is trying to build some bullish momentum, but not really going anywhere. The 821 have crossed back to the downside. The weekly chart looks pretty atrocious. And then the monthly chart, again, we're melted down almost to the 382. It just looks nasty. It just looks absolutely disgusting. Excuse me. Basic attention token on the daily, getting a hard sell signal. Trying to build up momentum. This is surprisingly holding up pretty well. It's one of the few cryptos that's above the 821 with the bull cross. So as long as it's above the 821, you know, probably does another retest of 44.7 cents. And then realistically, you know, the bullish retest or reversion to the mean of the 200 exponential and simple lines up almost perfectly with our fib here, which is the yellow 382, somewhere around like 65 cents. Now, how does BAT get to 65 cents from 40 cents when everything else is melting down? I don't know. I have no idea. Okay, but that's what the chart's telling us. Seems likely. So now, what invalidates that? Well, if we break back down below 38 cents and we start closing dailies and the 821 crosses back bearish, well, we probably revisit the lows at 32 cents and then go to our next fib down after that, which is, you know, a stair step on the way down to like 19 cents. But right now, as long as we're on the bull cross 821 to the upside, it looks like we get the reversion of the mean play. So maybe some bullish news comes out for BAT, some fundamental comes out, some news. Everybody, oh my God, you know, BAT just reached like 10 million users or a billion users or whatever. And, you know, all of a sudden they're doing some crazy promotion or, I mean, somebody's acquiring that. I don't know. I don't know what the fundamental things can be. I know the chart is telling us that this crypto looks better than all the other trash cryptos. But again, is it just, you know, dirty laundry that's not as dirty? Yeah, definitely. 821 monthly have crossed the downside. So what would that be? It would basically be a retest of the cross, you know, and then just rejection probably, where we go much lower. But again, the daily looks actually okay on this. Barely, but it looks okay on this. Chainlink continuing to melt down. 618 right below us there. Holding on to this level for now. Daily is obviously very bearish. Trying to build some momentum, but still very bearish. Weekly, still very bearish. No divergence. Hanging out at the 618. Does not look good. And then the monthly, obviously we had the bear cross. Looks disgusting. Hanging out at the 618. Next target to the downside is probably $3.10. Does it get there? When does it get there? I don't know. There's definitely some stops along the way. $4. It looks very weak. Bears are clearly in control. All red histograms, literally since the top. It's like these weird indicators are not just on our chart because they're colorful and fun. They actually serve some purpose. It's very strange. Very strange. Whoever created these, I mean, obviously, a goddamn genius. A genius, I say. Or just a regular guy that's trying to share some cool stuff with some peeps on the internet. Probably that one. That's probably that one. Algo, not looking great. Below the 618, kind of just hanging out here for now. Looks like likely we're going to get our next move down. We kind of already retested the 618 and it acted as resistance. We got new weekly close. Seems like we're going to the 786. There's a little support around this area, but, you know, is Algo going to be at 20 cents in the very near future? It probably is. It probably is going to be at 20 cents very, very soon. And that will either be the buying opportunity of a lifetime or just one more step for the slinky to bounce off before it goes much, much lower on its inevitable trek to zero. Well, maybe not inevitable, because honestly, I don't even remember what algo is. But it's probably shit. But it's probably not as bad as some of the other shit. Well, it's definitely not as bad as some of the other shit. Like, what's a really bad one? Oh, SHIB. SHIB is really bad. Shiba Inu is the worst crypto ever. At least top 5 or bottom 5, depending on how you look at it. If it's good to be the worst or not. XMR Monero, not looking good. Hanging out at the 0.5. Daily, again, trying to do something, a little bullish divergence. There's still some hope for the macro cup and handle. Yeah, I don't like that it's just kicking it at the 0.5 like that. Probably goes to the 618, which is our target of $81. We're at 117 now. Probably goes there. Very close to confirming the 200 simple bearish. And we never have seen in this thing's entire life the 200 simple and the 200 exponential both be bearish at the same time. Here the 200 simple is still bullish, 200 exponential is bearish. Here 200 exponential is bearish, simple is still bullish the whole time. Here the 200 simple goes bearish and the exponential is still bullish. We see like one little flash right here where they're both bearish at the same time, and then we put in a lower high, and now 200 exponential is very bearish, 200 simple has confirmed bearish. It's basically flat right now. So I mean, it's very, very close to legit confirming into a weekly bear market. And again, please keep in mind on Monero that we basically double topped the 2018 all-time high. So this has failed to put in a new all-time high this entire bull cycle. So it's not as shitty as XRP. It's not as garbage as Dash is, because they didn't even come close to putting new all-time highs. But it's pretty damn shitty. All the money that flowed into crypto space, all the new people that flowed into crypto, all the bullish exuberance in crypto, and somehow less money flowed into Monero than ever before, or arguably around the same. But that's not good. This is not what a bullish chart looks like on a weekly or monthly time frame. This is what a dying asset looks like right before it goes much, much lower. So in all reality, if we double topped right here, and that's the top, I don't see any reason we don't double bottom. At least come back down and retest the bottom, possibly break through it. But I don't see any reason that Monero doesn't sell off as heavy as it did. So $40 Monero? Probably. And what's the fundamentals going to be? Well, the government just says, hey, no more privacy coins, because actually the CIA created crypto so that we can monitor all your transactions and have control. And so no secret coins. No. We want to see your chain so we can stop you buying and selling shit. And if you're bad, we can social credit score your ass and take away your money. But crypto money. And again, I'm not saying that's true. But if that just so happened to happen in the future, and they were like, Satoshi Nakamoto actually means CIA, would you be surprised? I wouldn't be surprised. But that's not my base case. But also, I wouldn't be surprised if the government's created crypto to get people, comfortable 20 years in advance and run like a giant test project, basically for central bank digital currencies. Seems realistic. Seems reasonable. Seems possible at least. Seems likely. Seems probable. Well, we'll see. ADA. Cardano, this thing just sucks. Just hanging out at support. Capitulation inbound in 10, 9, 8, 7. This thing is just ready to let go. So Cardano at 23 cents. In my opinion, that is 23 cents more valuable than it should be. But looks like we're headed there. It's at 45 cents now. Time to lose another 50% of your money, Cardano. Congratulations. But I stake and I make 10% per year. Oh, okay, great. So how's that going for your principal? Well, my principal is down 92%, but I'm making 10% per year. Okay, congratulations on being a horrible investor. Congratulations on Cardano beads. KNC, Kyber Network, again, down here at support. Don't want to see it lose these levels. It's already hit 786. That's the last level of support before, revisiting the bottom. And then also we have this ascending channel, and we're at the bottom of the channel. So this doesn't look good. Now, granted, it could just be a spring and shoot back up here. But before I'm ever considering entering into this trade, I want to see it closing back up here and then holding that support and starting to creep up as momentum builds. If we're below support and momentum builds, I don't care. It looks like a fake out to me. So again, you know, obviously we put these setups in place sometimes and then talk about what has to happen for us to enter them, or if something specifically happens, we're not going to enter them. And in this case, closing below that support line is basically a no-go because it tells us we're probably going to keep just coming down here and putting in new lows. Now, again, arguably, you know, we draw these charts and sometimes, you know, they're not right or they look better drawn a different way on a different time frame. You know, it's not all about just like, well, I drew it this way and I'm always right, so I'm just going to leave it this way. And if price action doesn't agree with me, price action's wrong. No, that doesn't work like that. So what we're looking at is, you know, is there a way that we could have drawn this, you know, maybe with just our closes on a weekly and it would still look okay? I mean, that looks okay to me. So if we whip down below this, it looks bad, but as long as we close back above this on the weekly, I think it's okay. What's it going to look like on the monthly? You know, again, it was probably the way we had it before looked better on the monthly, in which case we have technically broken down from it. So it could kind of go either way. It's just, I think at this point in time, like, you know, draw it both ways and trust each of them equally until one of them is proven right. But for now, I think it's not terrible for now, but that could change very, very soon if it starts closing longer time frames below the area it's at right now. So it's basically do or die for Kyber Network. And last crypto of the day, waves. So we bounced the 0.5 a couple times. We back tested the 382. You know, we have this kind of like just sloppily drawn in descending resistance line, which obviously it's having trouble getting above. If we can get above it and start closing over here, cross above the 821, we like to get a move back to 767, which is like a 50% move. I mean, it's no fucking joke. 50% in probably what amounts to a couple days. You know, if that happens, obviously. But realistically, what we need to watch for is if we break below the 0.5, 424, we got to get the hell out. Or we don't want anything to do with it, as we're just basically going to come down here probably to like $2, 213. So the real question is, you know, does it go up here and retest like 775, or does it break down below 411 first? Obviously, we don't know. But, you know, it's like 20% downside with, you know, 50% upside. So is there a trade set up there? I mean, really, no. Because we want to have at least 3-to-1 risk reward ratio, and it's going to be like 2.5. So in my opinion, no. Is there a different way we can kind of finagle it to make it possible or decent? Yeah, maybe. But if we just retest the 382 and we say below the 0.5, we want to be out. That's 22% downside and 46% upside. So it's like 2-to-1 risk reward ratio, which is not good because it's counter trend, because it's obviously a bear trend and we would be taking a bull trade. So, you know, not worth taking in my opinion. Now, realistically though, if it, you know, just all of a sudden had a really bullish performance and we get a back test of the 200 exponential and simple, or a back test of the 236, you know, then we're looking at 200% upside versus 22% downside for a 9-to-1 risk reward ratio. But, you know, realistically, we want our initial trade setup to be good, take profit, and then leave part of it on the table. And the initial trade setup's not good enough to even enter. So realistically, like, this is pointless. Now, is there a different way we could kind of finagle this a little bit and just take like a little more like reckless of a entry with a much lower probability of success? Sure, we put in a 5% stop loss. If we close a daily below like $5 basically, like below 498 or something like that, we want to be out because we took out this, you know, area we're consolidating at. But then we can still use that upside target because it would be a breakout of this descending resistance and then a back test of the 382. So we have still a 46% target, but now a 5% stop loss. So we probably get stopped out. Let's be real. Or close the trade at the daily close, however we're doing it. That probably happens. But we're risking $5 to make $46. So there's enough risk reward there at 9-to-1 that there's a strong argument to say, well, fuck it, I want to take a trade, and this looks better than all the other trash trades, so I'll bite on this. And it probably fails. But again, in my opinion, now is more of a time to be conservative. All right, but that's it. We did it. We tore through those assets like it was our job or internet hobby. Let me jump over in the comments here, and then we're going to go ahead and wrap it up. Make sure you smash the like button, subscribe. Obviously, remember, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. What's up? Crypto Galt says 2 lives in 1 week. Yeah, woohoo is right. Galt, I stream 3 times every single week. Every single Sunday, every single Wednesday from 8 p.m. till 10 p.m. and every single Friday from 11 a.m. until 2 p.m. or 1 sometimes Eastern Standard Time. So every week, 3 live streams, always. Crypto Galt says, gotta be going further down. Yeah, it looks like it. Bitcoin definitely looks like it's going further down. Calma Betty says, Bitcoin below 10K in October. Yeah, I mean, seems likely, dude. Definitely seems likely. I mean, 14 and 16K is the area to watch right now. I'm not going to sit here and say like it has to go to 10K because it doesn't. But that's where slinky theory comes in. We just look for our next target to the downside, and then we play it by ear as we go. We want to have a bunch of targets to the upside. We want to have a bunch of targets to the downside, but we're just looking for stairs. Stairs on the way down, stairs on the way up. Todd, good to see you, brother. Appreciate your appreciation. Thank you for everybody for tuning in today. We're going to go ahead and wrap it up there. Going to be a fun and exciting week. Beginning of the second half, beginning of the third quarter. Lots and lots of excitement. Very, very excited. Tons of money to be made coming out of the bear market. Could still be a long while till that happens, but this is what separates the men from the boys, so to speak. But that is it for today. It is Sunday, 10:25 p.m. on 7/3/2022 Eastern Standard Time. Thank you all for tuning in today. I am, of course, the one, the only legend crypto trend trader. And I'm getting the fuck out of here. Peace.